What's up, everyone? It's Karthik with MoneyVest for your market close live stream. We've got under 40 minutes left for the markets to close. And boy, I'm just waiting for this market to close because I haven't even looked at my portfolio today. Probably down significantly on the back of this massive tech sell-off, and the Nasdaq here just can't seem to find any type of support. It's down a little bit over 2%. Right now, with the S&P 500 down over 1.5%, so just under 1.5% at the moment. Nvidia trading down to 133. We're down over almost 4% on the day, and Tesla down over 2.6% on the day here. So if you guys can see me and hear me, just give me a thumbs up. I just want to make sure that the audio and the video is working well. We are ready. We are pumped up and excited for this market sell-off because we are going to be taking advantage of these opportunities. If the markets continue to roll over here as volatility spikes, the MoneyVest index comes down, there's going to be buying opportunities. We're going to be cash ready for this. So volatility is trading back up. So it's up a little bit over 10.5%, trading up to 22.4. Again, if you guys can see me and hear me, just give me a thumbs up. I just want to make sure that the audio and the video is working well and there aren't any issues. There aren't any technical issues with the chat here. So I'm not able to see any comments, any chat. So let me know if the audio and the video is coming through because there's literally no chat. There's nothing on the chat right now. So Apple, Amazon, after the bell, these are the two big companies left in Magnificent Seven. Tesla's already out. We got Google, Microsoft, Meta that reported yesterday and earlier this week. Apple, Amazon is going to be today after the bell. And of course, we got Nvidia on November 20th. So later next month is when we've got Nvidia numbers coming out. Folks, do me a favor and drop a like, subscribe, and share this live stream with other traders, investors, family, friends, other groups, where we can have more and more people join us for this market close live stream as we continue to see a pretty brutal sell-off here on the day. So just do me a favor, drop a like, subscribe if you haven't already, and share this live stream. I'm going to copy the link and paste it in the chat so you can share it with your other friends, other traders, investors in other groups, and have more people join us here so we can have a pretty lively, engaging discussion around the market close here. Now, there wasn't a lot of catalyst that resulted in this market sell-off. I'm going to go over some of the economic data that came out earlier today. We did have things like the continuing jobless claims, the 4-week average of the jobless claims, initial claims, as well as the inflation numbers that came out. And I think the core inflation, a little bit higher than what the expectations were, kind of spooked the market a little bit. So we've got almost 100 people watching right now. I'm going to do a quick poll, quick question for all of you. And that is what you think is the market sell-off for today in terms of a dollar amount in the S&P 500. So what is the total amount in the S&P 500 in terms of market cap that we just saw an unrealized loss in the S&P 500? What was that dollar number? I want to hear from as many guesses as you guys can give us. So let's hear it. Let's hear it in the chat. If you guys can come up with a guess for the total sell-off in the S&P 500 today. We're down almost 1.5%. So we're starting to see a little bit of that recovery back up. Still down 1.4%. But what does that equate to in the S&P 500 in terms of a dollar loss? How much of that market cap in the S&P 500 we essentially erased in just one single day? What's that number? Oof, Fatal Error says 2 trillion. That's way too much. That's way too much. 2 trillion would be crazy. That would be insane. Alaire says 6 billion. Win says 3.5 billion. That is really, really low. I mean, if you just think about Nvidia alone, Nvidia is well over $150 billion alone, right, in terms of that company's market loss. down almost 4%. And for a company that's worth over 3.5 trillion, even a 4% loss is a pretty significant chunk of the market cap there. We got Vineet at 700 billion. Waityear says 0.5 trillion, so 500 billion more or less. Sunita says 82. I'm assuming that's 82 billion. Sebastian says 1 trillion. So again, put in your guesses. Put in what you think for the market cap loss in the S&P 500 today has been, given that we're down a little bit over 1.4%, down 2.5% from our all-time highs. And this right here is the perfect representation of this rising wedge starting to break down. So again, let me know what you think is the market cap loss. We're going to go over to the market concentration tab on our MoneyVest platform and then show you guys exactly how much we're down for S&P 500. I want to see more guesses. We got over 133 people watching now. Where are all the guesses? I sure don't see 100 guesses right now. So I want to see more engagement. Come on, folks. We got to get more excited. These market sell-offs are nothing but great buying opportunities, as I've mentioned before. So we gotta get more lively here. We gotta talk more about the markets and see what's going on. Like, is this an opportunity? Is this something that we gotta wait on a little bit more? Gotta prop up on that buying power a little bit further. Or what's the next move? I mean, Apple and Amazon are reporting later today, so that's going to be a very, very important earnings. Apple, of course, as we know. I see it on the site. I don't want to cheat. 400 billion, 300 billion, 300 billion. So okay, let's just reveal it. Moment of truth. If you come over to market concentration, we are, folks, down over $700 billion, $725 billion for the S&P 500. And off that, Magnificent 7, Max 7 alone makes up for over $500 billion. $500 billion, which is just Max 7 alone. Top 10, $536 billion. The big three, which is Nvidia, Microsoft, and Apple, down over $334 billion. I think majority of that is coming from Microsoft, which is down over $161 billion. Oof, taking a beating today. Down 5%. I don't even remember the last time Microsoft was down this much in one single day. So $161 billion loss for Microsoft. Nvidia coming in second with a triple digit in billions of dollars worth of losses, $133 billion. Then we got Amazon. Amazon also getting slapped around here, down $63 billion. Meta's down $60 billion, almost 4% down. Apple is down the least, only down 1%, and Google is down 1.4%. And we got Tesla down over 2.7%, $24 billion losses here. Vineet, I'm not sure. Did you see it on the platform? 700 billion. You were pretty darn close. 700 billion loss. It's a pretty significant chunk of that money. Now let's take a look at where the money is actually flowing to. So if you come over to the energy sector, you'll notice that collectively they're up 1.27%, or $21 billion. That's 22 stocks. And some of the big leaders here, we've got ConocoPhillips, you got Chevron, Exxon leading up to the earnings. They're reporting tomorrow pre-bell. They are up 2.7, 2.4 billion respectively. If you take a look at financial stocks, so if you come over to financial services, they're also down 70 basis points or $30 billion. But if you take a look at, let's say, banking, for that matter, I think that might be up, still down 0.5%, $8.6 billion. Let's take a look at consumer products, down 1% or 9.3 billion. Let's take a look at healthcare, down 30 basis points or $7 billion. Let's take a look at utilities. So two sectors that are actually doing very well is utilities and energy. Utility, energy, both of them are kind of seen as like recession-proof sectors, a risk-off sector. And utilities are up over 1.4% or just over $17.6 billion. Now, after a really long time, and I'm actually doing a lot of analysis on this as well, which is going to be analysis on the MoneyVest index. We just got some historical values, and we're going to be, Vineet says, no, I counted. Oh, no, you counted? But that's a pretty good guess, man. That's incredibly good here. So KK says, bro, your website is mad good. Thank you so much. I appreciate that. And it's only going to get better because we're going to be adding new features pretty much every single month. But for the first time in a long time, the MoneyVest index has dropped below 3.5. So we're now come down to 3.38. This is perhaps one of the most important metrics for me personally That's why I've included this on the website. It's neutral rating right now, so meaning that the market's risk reward is pretty neutral. We're not in a euphoria or greed type environment. At least we were at that level. We were well over 4.5 not too long ago, and we're now coming down to 3.38. So we are in a pretty neutral zone. The moment this dips below 3, which is where we were in the first week of October, first week of September, not the first week of October, first week of August, and first week of September, those were very, very good buying opportunities. And that's exactly why I've got this over here for you guys. And we're also going to be including next week, we're going to include the historical chart right over there. So you can see at the bottom, you'll be able to see this chart right here, which is showing you all the historical values for where the MoneyVest Index has been. So you can then look at specific dates and look at when it was trading at below 3, above 4, and kind of do your analysis and figure out, okay, whether it was a good or a bad buying opportunity. As I mentioned before, our focus is very much on quality over quantity, meaning that we're going to be looking at fewer buying opportunities, but those buying opportunities are going to be very, very precise. They're going to be well calculated. They're going to give you the best risk reward ratios, very well optimized for making the most value for your investment. So that's the whole idea, right? Not every dip, not every correction's a buying opportunity, but we're trying to figure out when that hit rate is at its highest. It's the peak risk reward ratio, and you can deploy capital. So 3.5 is going to be the next one that we're watching right now. Of course, low 3s is going to be somewhat ideal, and anything below 3 is just this Christmas coming in early for the market. So, we do have a lot of stocks, of course, more specifically technology that's selling off very aggressively. The only stock that's kind of managed to stay green right now is Netflix, up about 0.5%, but everything else, of course, down anywhere from 1 to as much as 5% here. We take a look at Microsoft. Just a brutal red candle with a gap down coming in. This stock was up. This stock was up after the earnings, but during the earnings call, they started rolling over on the back of, higher AI spend, infrastructure spend for moving forward, right? So that, of course, is causing a bit of a problem for the markets as well. So is your website for everybody? I thought it's for paid members. Yes, it is for paid members only. So right now it is only available for paid members. This is still internal beta. So right now, we're still working through over the next several months to fix a lot of bugs. There are some data discrepancies which we are going to be fixing. We're still going to be working through, maximizing the UI and making it better, including more things, more features, fixing a lot of those data discrepancies, fixing a lot of technical bugs, and then eventually, of course, it's going to be ready for the big public launch, and there's going to be some free tiers, some other paid tiers, and we're still working on with getting access to more data APIs and more third-party vendors to give us the data that we really need, and then, of course, cover up layer with our own analysis on top of that. So there's going to be a lot of really cool stuff that's going to be coming out. And, these are all out-of-the-box solutions, like things that you'll never find anywhere else, things that are going to be only specific to us at MoneyVest, very, very creative type of analysis. And there's also going to be some more community-curated analysis as well. Things like you guys want to see on the platform will include for that as well, because I know there's a lot of interest in the MoneyVest Index for individual stocks. What's the MoneyVest Index for, let's say, Apple or something else, whether it's a buying opportunity or not. So we're working on that, and that is a little bit more complicated of a formula, but we'll figure it out. We're going to back test it. We're going to do some deep back testing to make sure that it works for all of you, and it's helping you as part of your analysis and decision making. So yes, so that's going to be it for that. Now moving over to some of the earnings. We're going to set up everything now because the earnings are less than 30 minutes away. So what we're going to do is we're going to keep Amazon over here at the top right. So there we go. It is down 3.4%. So definitely, obviously very, very weak. And then we've got over here, we got Apple. On the 5-minute chart, we've got 1.3%. And of course, they're reporting after the bell as well. What other companies can we look at? And again, we're going to break down the economic calendar stuff as well. But we got Mercado Libre. We've also got Intel. So I think we should definitely include for Intel over here because they're also reporting today after the bell. And then finally, let's just scroll down and see if there's any other companies. Vici Properties. If there's any other companies you guys are interested in that are reporting for today, let me know, and we'll include, we've got one more spot left for the bottom left of the screen. Maybe Atlassian. Atlassian's a pretty good company to look into. 66 cents in earnings per share, with about a $1.18 billion in revenue expectations here for the company. Amazon is the only hope. By the way, we've got a poll going on right now. I got 137 votes. Can Apple and Amazon save the market today? Because of how much of a sell-off we've seen, can these two companies come in with some strong numbers and save this market? Can they lift hopes? Can they lift the markets higher? Let me know. Let us know. We've got a pretty split vote. 50-50? Are you kidding me? This is about as split as it gets. Maybe a small edge to... It's kind of fluctuating between yes and no right now. It's crazy. It's fluctuating between yes and no. So you guys are pretty split on this question, whether Apple and Amazon can save the market or not. And wow, I've never seen such a split vote. 50% people think that no, they can't save this market right now, even though they come in with some strong numbers. Markets are still going down further. Man, imagine if Apple and Amazon drops after earnings. It's going to turn into even worse. As if 2% wasn't bad enough. If Apple and Amazon actually do drop after hours, it's going to get pretty brutal. Could get much, much worse, folks. I mean, easily 1% on the Qs. If Apple drops anywhere between 4 and 5%, and Amazon also drops, let's say 8 to 10%. Yeah, we definitely could use some green here from Apple and Amazon here. So that's going to be the main focus. And now going over to the earnings expectations, Apple expected to report $96 billion in revenue, with an EPS coming in at just over $1.58. So that's going to be the expectation there. Amazon sitting at just over $160 billion of revenue expectations and about $1.16 in earnings per share. So those are the two big Powerball lottery numbers that they need to hit in order for us to at least have some hope the market's going to be saved after these numbers. And yes, unemployment numbers are coming out tomorrow. Yeah, even if they beat the call is what matters, correct? That's what happened with Microsoft yesterday. It beat expectations, came in with some very strong numbers. It rallied after hours, 3 to 4%, then sold right back down after the higher expenses, infrastructure spend, CapEx. Same thing happened with Meta as well, right? Meta on the day is also down a little bit over 3.8, almost 4%. So, increasing significantly on their CapEx spend, even though the numbers came in very strong. Daily active users, monthly active users, pretty much everything grew on a year-over-year basis. But Wall Street doesn't want to see higher expenses. And so stocks obviously not performing as well. Now coming over to some of the economic calendar stuff, we've already broken it down in our previous live stream, but just giving you guys a quick run through. Personal income was up 0.3% month over month. Compared to the estimates of 0.3%, so on par with expectations. Now, when it comes to inflation, which is the Fed's preferred measure of inflation, PCE, right, that's the personal consumption expenditure, year over year sitting at 2.1%, which was the actual number, on par with the estimates. Month over month also on par with the estimates of 0.2%. Initial claims, 4-week average came in at 236,000. Prior number was 238, so we're seeing a slight decrease, 2,000 jobs less on a 4-week average basis. And initial jobless claims coming in less than what the expectations were at 216. So this, again, continues to show us a very, very strong labor market. We've got less jobless claims filed in the last week. However, the JOLTS numbers, the job openings, continues to drop here. 7.44 million is significantly lower than 8 million. So that just shows us that, there's well over 560,000 jobs that are now fewer in the U.S. economy. Now, the most important number was core PCE. As we know, the Fed's preferred measure of inflation has always been the core inflation, which is excluding for the food and energy. Core PCE year over year sitting at 2.7. So that was one of the problems because it came in hotter than what the expectations were at 2.6. So again, there's no change there. We're pretty much sitting exactly where we were last month for core inflation year over year. That is still 70 basis points higher than the Fed's target. And month over month coming in at 0.3%, which was again on par with some expectations here. The 4-week bill auctions. So the yield awarded at 4.5%. Previous was 4.65. The 8-week bill auction, so 2-month, 4.555. 15-year mortgage rate increasing. So I was actually talking to my friend earlier today, where mortgage rates are on the move back up, right? So that's obviously not good news. And that's why we saw the MBA mortgage applications, which came out yesterday, or it might have been today. Let me just quickly go over that because I remember talking about this in our Discord. Let me just go over this very quickly. There we go. So MBA 30-year mortgage rate sitting at 6.73%. The mortgage refinance was sitting at 630, so that is a huge decline on a month-over-month basis. And then we had the mortgage applications. There we go. So declining another 0.1% on a, I think this is week over week. So week over week down about 0.1%. Also coming down to 214.5. Previous number was 214.8. So these are the index values. And this right here is the week over week change of 0.1%. So, obviously we're seeing a little bit of that softening. And I think refinance index was also there somewhere. Purchase, and there we go. Refinancing also dropping significantly from 672 down to 630. So that index is also down about 42 points. So purchase index increased a little bit, but refinancing activity, mortgage applications, we did see those things come down. And GDP numbers obviously came in a little bit softer than what the expectations were. Came in at 2.8%, and price index was down to 1.8% versus the consensus of 1.9. So you've got an economy that is showing some signs, like some mild signs of really starting to show some cracks, and at the same time inflation stays a little bit more elevated, especially when we're talking core inflation. Headline inflation's coming down. That's great. It's back down to 2.1%, practically pretty much within target of the Fed. But core inflation, right? That's the real issue. And who can tell me why core inflation is not coming down fast enough, and why is there such a big decline in headline inflation? So a very, very quick pop quiz question. We got almost 300 people watching, and I'm pretty sure that I think most people will be able to answer this question. Why is headline inflation going down faster than core? Why is it that headline inflation is sitting well close to the Fed's target of 2.1 when you're looking at PCE or even CPI versus core inflation, which is taking its sweet time to come down? It's still above 2.5, 2.7, closer to 3%. What is the reason here? The Fed's balance sheet actually comes out 30 minutes after the bell. So 30 minutes at 4:30 p.m. Eastern. We've got the previous number sitting at 7 trillion. So we're going to get a little bit of a read on the Fed's balance sheet as well. And yes, so oil and shelter, both of those things, right? Energy, because of the significant deflation in energy prices have come down on a year-over-year basis. Headline is trending lower significantly, but once you strip out for energy in core, shelter is what's keeping it higher, right? So that energy deflation is not part of the equation when it comes to core inflation. And as a result, core is still pretty elevated on the back of shelter prices, which makes up for about a third of inflation. So, that discrepancy there is the Fed's biggest challenge, is the cost of fuel, oil at the gas station is still pretty elevated. And we were at least seeing crude oil prices higher for the month of October. I mean, they're back up 2.2% on the day. And if you come over to the month of October, today is the last day, folks. So we're going to be pretty much closing in here very, very soon. We're still up 3.4%. So that is going to be affecting transportation cost, jet fuel, oil prices at the gas pump, pretty much everything increasing in the month of October, thereby putting some upwards pressure and impact on inflation as well. So that is something to keep in mind, because we've got the inflation numbers coming out, I believe, on November 11th. So, by the way, before we get there, mortgage applications, the mortgage rate sitting at 6.72% for the 30-year, and 15-year sitting at just shy of 6%. So mortgage rates have certainly creeped back up. And of course, tomorrow we've got November 1st, the first Friday of the month here. We got the unemployment rate. Unemployment number, 4.1% is the expectation, with the U6 unemployment rate at 7.7% and participation rate at 62.7%. We're also going to be plugging in our own values in my own spreadsheet to kind of show you guys exactly some of those numbers as well. But let me just take a look at when inflation numbers are coming out. We got consumer sentiment next week. Of course, we got the presidential election, the FOMC meeting next week on my birthday, November 7th. And this right here is when inflation is scheduled for. And that is going to be on Wednesday, November 13th. So there we go. Inflation rate month over month, year over year. CPI, core inflation, year over year, core CPI month over month. And of course, PPI numbers are going to be on Thursday, November 14th. So 2 Thursdays from now is when PPI numbers come out, and a couple Wednesdays from now is when CPI numbers come out. So inflation is not next week, but the week after. But of course, next week is we've got FOMC and the elections. Very, very important stuff scheduled. Srinivas, what is Money Index number now? Is it still an optimistic state? No, so we're back into neutral zone. We're at 3.39. This was updated just a few minutes ago. So we're in the neutral zone right now for the market. So we are, from a risk-reward standpoint, pretty neutral, as the S&P is down over 1.5% and the Nasdaq's down over 2.2%, and volatility still pretty elevated at over 11.7. So how many people here think that we're going to break out above 23 for the VIX once and for all, break out to the highest level since the yen carry trade blow up that we witnessed back in August? We're going to do a poll for the volatility next because I'm kind of curious what everyone else is thinking. And if you come over to something called the VIX Central, you can pretty much look at this yourself. Let me see. Okay, what was the website? VIXCentral.com. There we go. So this right here basically shows you the VIX futures term structure. And right now you'll notice that we're still in backwardation. That simply means that if this number is negative, we're in backwardation, versus this number is positive, we're in contango. Contango is where we really want to be, because ideally, the farther you go out in time, the more uncertain the volatility is. And thereby, you need to have an upward sloping curve where the longer you go out into the future, the more uncertain you are. And that's why the volatility is going to be higher. But if this is in negative, that means the short-term volatility future, which is expiring in November, is trading at a higher level than the one in December. And, we talked about this kind of leading into the elections and the FOMC. The November future VIX futures were going to be priced higher because of all the uncertainty around elections and the FOMC, and of course the earnings season. So this backwardation has almost always been a signal to be cautious. It's one of the metrics that we use as part of our analysis when we're trying to decide whether the markets right now are favorable or not from a risk-reward standpoint. But, it's possible that kind of going into next week, it's possible that volatility is higher than 23. We kind of push past that level and break out even further to highs of 24, 25, 30 again. You never know. FOMC is really the big catalyst next week, along with, of course, the elections. But yeah, Guns and Ammo says, I hope not ready for it. You better be ready, man. I've been kind of slamming the table here, getting everybody to get ready, because the VIX spikes. It's time to start deploying again. And the buying windows are not that long. They're actually pretty small. If you basically just take a look at every time we've seen that spike, the volatility has been higher for maybe a day, maybe 2 days. That's about it. And even in August, the volatility got up to as much as 65 and only lasted there for 2 hours. 2 hours, you got your opportunity from 8:30 to 10:30. And next thing you know, we're back down to under 40 here. And a few days later, we're back down to 20s again. So the buying window is short. It is quick. That's why you got to be ready to take advantage of when the market gives you that opportunity. Folks, do me a favor. We are now less than 15 minutes away from markets closing. And then, of course, we've got a lot of really important earnings like Apple and Amazon that are going to be reporting. So do me a favor, drop a like, subscribe if you haven't already, and share this live stream with other traders, investors, people that can join us, and we can have a more lively, engaging discussion. I would really appreciate that. Helps us grow the channel and also get us to have a really good discussion around the market. I'm going to talk a little bit about some of the comments here. There's something called exhaustion. Stocks will recover regardless of today's earnings report. Yes, it's possible. And, I don't expect more selling pressure, but I'm just kind of curious to see what will happen with the market if, of course, Apple and Amazon do end up selling off, post earnings here. Yeah, so with every recession, you see a nice slide in oil. What stocks are go to buy for short-term holds, 6 months to 1 year? So Mahi, again, that's a little too short of a time frame. With that kind of time frame, you're mostly looking at position trading or like trading for the medium term. I think it's going to be more geared towards stocks that have the potential to continue to beat expectations, provide with some very nice growth rates over the next couple of quarters, and also are gearing up for a nice technical breakout, trading at near support levels, forming a bull flag or an ascending triangle, something that you can kind of look at from a technical chart standpoint, as well as the next couple quarters of earnings that are expected to be very strong from a growth standpoint on a year-over-year basis. So those are some companies that I would look at. Of course, if you want ideas, if you want some other ideas, shopping list is always available on the MoneyVest platform, where I do share 29 to 30 stocks that I have on my watch list that I'm ready to deploy into if there's better opportunities, if they come down to my buy targets and the technical values that I've put together, as well as my fair values. So, okay, it's a 50-50 really. Earnings can save the day after hours. This is just a blatant earnings rug pull. It's possible. I mean, we've seen this before, right? I mean, it's not something new. Like, I've seen the market sell off prior to the earnings for some of these major companies, and then once the earnings come out, they pop back up, and the markets are literally back to where we were, right? And then those memes start coming in that we're back. We are so back. And QQQs, again, 2% sell-off is nothing small. It is pretty decent sell-off. And if you compare this to Tuesday, the NASDAQ is down over 3.3% in just a matter of 2 days. So, yeah, I mean, that's a pretty decent sell-off here in the NASDAQ, and we'll see if Apple and Amazon have what it takes to kind of improve the situation a little bit. The yen thing with Japan, yeah. So, I mean, again, it's kind of hard to say, like, if that is still going on, right? To what extent is the yen carry trade already over, or if that's still happening? It's kind of hard to say, but yes, I mean, there's always been some problems with that, because if you take a look at the 10-year treasuries, of course, the 10-year treasury yield obviously pushing out 4.28, almost 4.3%. And I forgot what that ticker was for JPY 10 or JP10Y. There we go. So Japan 10-year government bond sitting at 94 basis points, right? So if you take that spread, US 10Y minus the JP10Y, there is still a lot of spread to capitalize on, right? We're still at 3.3%. So, obviously borrowing from Japan, from banks over in Japan, and then investing over in the US for treasury yields, there's still a lot of spread to be made. But of course, there's this concept of this margin call getting issued on the back of Japan, increasing interest rates, thereby causing margin requirements to go up, and obviously the dollar index coming down, which is obviously depreciating their dollar-denominated assets, especially when they convert back into Japanese yen. So that could still be happening. That could still be going on behind the curtains. But in my opinion, I think bulk of that trade was unwound in the first week of August. So I don't think that is the big catalyst here. There could be some profit taking right now. What are you thinking about buying Mahi? So again, there's Magnificent Seven, of course. Then we, of course, have a lot of other long-term high-quality stocks that are on my watch list that I'm really looking for deploying more cash into. I'm also going to be looking at rolling out NVIDIA towards the end of next month. So November 29th is when my NVIDIA calls expire. They're already in the money, of course, well over $15, $16 in the money. So we'll be looking at rolling these out to December. And we'll see if I can increase that capital gain just by a couple dollars, profit per share. We'll see what happens. SOXL puts that were expiring this Friday, I rolled them out to next Friday, lowered my cost basis even more, and then of course collected a little bit of premium on that as well. So not too shabby. And then Tesla here, I've got February calls, 2025, so got a long way to go, but we're very close to the money now. 251 is where it's at the moment. Okay, folks, we have less than 10 minutes for the markets to close. And of course, the numbers to come in. What is everybody thinking? What kind of trades is everybody taking right now on Apple and Amazon? Let me know. Let me know what kind of trades you guys are taking. We're going to put Apple here, Amazon over here, and QQQ is at the bottom left. And we are ready to go here. In less than 10 minutes, the markets close. Earnings may come out 5-10 minutes after the markets close. But these are the two companies we're going to be focusing on very, very much. Earnings call is an hour after the markets close. At 5 p.m. Eastern, 2 p.m. Pacific is when both of these earnings calls start. They both actually start at the same time. So, strangle on Amazon and Intel. I think it's SPY puts for next week, Fatal Error says. So yeah, let me know what kind of trades everybody's taking on right now on Apple and Amazon. Who's got a horse in the race after the bell? Oh yes, Intel is also reporting after the bell. Let's just quickly go over their expectations as well. So Intel is already down 3.5% here. Earnings expectations of negative 2 cents per share. Revenue just over $13 billion. And if you come over to the market calendar, just double checking those numbers here. So there we go, 2 cents, negative 2 cents in earnings per share. Revenues of just over $13.2 billion for the company. So that's the revenue. And of course, EPS expectations here. Let's do this. Apple is way too expensive, Roberto says. Yeah, I mean, depends on how you slice it, right? It is sure trading at a valuation that, considering its earnings growth, probably doesn't deserve to be trading at that level. But at the same time, I mean, Apple is the king of financial engineering. And, you know, the amount of buybacks they do is insane. Every single quarter, they're dumping billions of dollars into their own stock to buy back and retire so many shares. If you simply come take a look at Apple's shares outstanding over the last like 7 or 10 years, let's just look at the last 10 years for Apple's shares outstanding here. Look at that. I mean, it's just been a massive decline from 24.4 billion down to $15.8 billion. And you know what else we can look at? We can also come over to, let's say, the fundamental analysis. I'm still going to plot for the shares outstanding for 20 years, which is going to be right there. So, you know, obviously it was increasing a lot up until 2013, and then take a look. Just a massive amount of buybacks here for the company. So 10 years is going to be much better to look at, right? Just a massive amount of share buybacks here. And then what else can we look at? We can come over to cash flow statement. And if you scroll down under cash flow activities from financing activities, cash flow from financing activities, you can see common stock repurchased or issued. If this number is positive, it's an inflow for the company. It's an issuance for shareholders. If this number is negative, that means it's an outflow for the company, and that means they bought back shares. So if you just simply plot this number right here, just take a look. It's been increasing, right? It's actually gone up 44 billion, 34 billion, 29 billion, 32 billion, and then take a look, 72 billion, 71 billion, 84 billion, almost $90 billion worth of shares they're buying back. Ridiculous amount. If you come over to the quarterly numbers, let's say last 16 quarters, again, it's been, you know, $20 billion per quarter roughly is how much in share buybacks Apple has done. So, you know, what does that do to the earnings per share? Well, it increases it significantly. If you take a look at the earnings per share, diluted earnings per share for the company, and let's just go over the annual numbers last, let's say, 20 years or so. I mean, take a look. Earnings per share, well over $6.13 as of 2023. Fantastic growth. You know, net income is not growing as fast as earnings per share. Why? Because of the significant amount of share buybacks the company is doing. So this is what the net income looks like. Of course, it's still up, but shares out, EPS is up much faster in terms of that rate of increase. So all of a sudden, you've got a stock that is increasing. Oof, another big down candle coming in for the market 5 minutes prior to the close here. And Apple hitting a new low of day, 226, down over 1.5%. Amazon's down over 3%. S&P is down 1.6%. And we've got QQQs down over 2.3% right now. Folks, we are less than 5 minutes away from market close. Do me a favor, drop a like, subscribe, and share this live stream with other people so we can have more and more people joining us just before market close here. We are ready to go. Ready to go. Tesla here getting flushed as well. It is down over 3% now. So 249, so under 250. Under 250. Volatility is up 12% right now. Let's take a look at the MoneyVest index. We are down to 3.37 at this moment. So 3.37. We've kind of been hovering around these levels. And look, we were at between 3.5 and 4 for a really long time before we finally cracked below 3.5. The reason being, I'm going to give a little bit of this away, but I'm doing some data research, like an actual analysis on the MoneyVest index based on the historical data that we have. Most of the time, the MoneyVest index, this is majority of the times in the last 4,489 trading days since 2006. We're going back over 18 years or something. most of the days, more than 40% of the days, the Money Invest Index spent between 3.5 and 4, right? Because of what? Because the markets have been so bullish, of course, they've been pushing higher. And so the Money Invest Index has spent most of its time between 3.5 and 4. So, that is a little bit of piece of information that we can use to better understand how bullish this entire market has been and how more often it is, right, for the markets to be up. So we're really trying to capture what? We're trying to capture rarity. We're trying to capture those extreme events, right? That rare events when the VIX is high, the Money Invest Index is really low, the markets are down so much. That's when you buy the fear. That's when you deploy cash into the market confidently, knowing that you're getting really good deals. You're buying very good risk-reward ratios at those levels. You're optimizing for the best opportunities. Anyway, so folks, here we go. 3 minutes left, everyone. And 52% of market participants say that Apple and Amazon cannot save this market after the bell. In other words, they are going to be down a lot, and QQQs are going to see much worse than what we just witnessed. Because look, Apple, one of the biggest companies in the world, Amazon in the top 5. If you come over to market concentration, we just cracked. Can we hit 900 billion in losses for the market? What do you guys think? Can the S&P 500 hit $900 billion of losses in the market today? Come on, 900. Couple more minutes left. Just one more down candle and we are 900 billion of market cap lost on the day. If you crack below like 5,700, we're easily there. Big 3 is going to be 386 billion. We got Mag 7 at just under $600 billion, and the top 10, just think about this for a second. The top 10 stocks, which make up for 36% of the market cap. By the way, JP Morgan is going to be dropped off. Tesla's going to make its way into this. We're just waiting for our third-party data provider to kind of update these numbers. 36% of the entire index makes up for over $18.6 trillion, and that is over $600 billion worth of sell-off for these 10 companies. So here we go. Going into the final minute for the market close. We're going to keep the S&P 500 down here. So SPY. And we are on the verge of closing red for the month of October. A minute left. This is the last minute of October 2024. And we are on the verge of closing red. S&P 500 and NASDAQ. I think NASDAQ also is going to close red. I might have to double check on that. But yes, the last time I checked, NASDAQ 100 is certainly red. I'm not sure about the NASDAQ composite though. But as we go into the final 30 seconds of October 2024, folks, S&P 500 is most likely going to close red. First red month in over 5 months here. Only the second month in 2024. April was red, and now October is going to be red. Boom, that's a pretty big down candle, 1.8% lower. And let's just reload this page, see where we are. Are we hitting 900? Are we hitting 900? And 980. 980, almost $1 trillion. We're 20 billions away from $1 trillion of market cap getting wiped out. So markets are closed 1.8% down on the S&P 5700. QQQs are down 2.5%. Pretty brutal. Now we've got Apple and Amazon just waiting for the results. And Amazon here down 3.4. Apple is down almost 2%. 52% here believe Apple and Amazon is not going to be able to save the market. So final number, 7 billion shy of $1 trillion. Can you believe it? Can you believe it? 7 trillion shy of $1 trillion worth of losses here in the S&P 500. Oof, that is crazy. But yeah, so we're just gonna have to wait for a little bit longer until these numbers get released, and as soon as they do, I will be sure to let you guys in on the latest numbers. And in the meantime, I'm also going to open up. So we're getting a bit of a pop on Amazon here. 4.5%. Looks like after all, Amazon coming in with some nice pops here. Oof, 193, 194. Okay, so numbers are out. Third quarter earnings per share, $1.43, beating expectations versus $1.16. Net sales coming in at $158.9 billion, $158.9 billion in revenue versus expected 157. So beat on revenue, beat on EPS from Amazon. After all, coming in with a nice little pop of almost 4%. Very, very good numbers. I mean, Google reported pretty strong numbers for advertising and cloud. So it was pretty much given that Amazon's going to beat expectations, but a nice little reaction from the market. The question, though, is can these gains hold up? Can the market hold up on this potential pop? Because look, same thing happened with Microsoft yesterday. Popped up 1%, 3% after hours, but then, of course, gave back all of it. In fact, was down over 6% today. So the real question is not the after hours move, but the real question is, can this be sustained? That's the real question. Because yes, it's nice to see a 4% pop, but it doesn't help us if it's going to be 6% lower later. So you're going to have to wait and see whether this gain is going to be sustained. First 3 candles coming in very, very strong, so that's good to see. Let's take a look at Apple earnings here. If they're out, not yet. And I'm going to try to open up the Amazon earnings here as quickly as possible. But nice little pop here, over 5% higher at the moment for Amazon. Incredible move coming in to save the market. Finally coming in to save the market. So let's take a look. Third quarter 2024 was being reported. Not yet on the Amazon website. But we, of course, do have it. 2 p.m. Eastern is when the 2 p.m. Pacific is when the earnings call will take place. But wow, 4.5% move to the upside. Intel also with a pop, 10.7% increase on Intel. And let's just take a quick look on Intel earnings as well. Very nice move, 23.85 is where we are on Intel, up 10.5, almost 11% right now. Intel earnings coming in at negative 46 cents. Negative 46 cents in earnings per share versus 3 cents expected. Revenue also missing expectations at $12.2 billion for the company. So $13 billion was expected, came in at 12.2. EPS negative 46 cents per share versus the expected negative 2 cents. Yes, Intel is also up over 10.5%. This is the chart right here. Very, very nice move from Intel as well. But Amazon absolutely crushing it. 6.5% move to the upside right now. So very, very nice move. Still waiting on Apple though. And no sign of Apple just as of yet. I mean, it could really offset Amazon's rally here. If Apple drops even by 3%, that could be enough because Amazon's market cap is 1.9, I guess 2 trillion. And Apple's is about 3 trillion. So we can really just kind of offset this if Apple drops by 3 to 4% after hours. It could really offset Amazon's gain here. So really what we need is either both up or both down. Or if one of them is going to go up, I'd rather have it to be Apple than Amazon because if we're really talking in terms of market, what do you guys think? Can Apple really save the market here? Because it really comes down to Apple at the end of the day. Because if Apple drops and Amazon pushes up, it's still going to offset Amazon by a huge amount. It's not going to be enough for the market, at least. Of course, for individual traders, Apple, Amazon is still pretty solid. Okay, let's take a look. Yeah, no signs of the quarterly results as of yet. Still look, Amazon's earnings on there. Yeah, Intel coming in with a double miss and still obviously pushing higher, so that's good to see. And let's take a look. Folks. Amazon again, $1.43 beating expectations. Revenue just shy of $159 billion. And there we go. Net sales increased 11%. Let me just take a screenshot of this and bring it over to you guys. Okay, so first things first, Amazon net sales increased 11%, $158.9 billion in the third quarter, compared to $143 billion in the third quarter 23. Net income increased to $15.3 billion, or about $1.43 in earnings per share diluted, compared to $9.9 billion same time last year. So that's a well over 50% increase, or 94 cents per share diluted same time last year. Operating income increased to $17.4 billion in the third quarter, compared to $11.2 billion same time last year. Operating cash flow, 57% increase, $212 billion. And then AWS, which is Amazon Web Services, increased 19% to $27.5 billion. And international segment sales were up 12% year on year to $35.9 billion. And North American sales also increased 9% to $95.5 billion for the company as well. So very, very staggering numbers coming in from Amazon. Definitely saving the market, at least doing its part. Revenue coming in guidance-wise, 181 to 188.5 billion versus street expectations of 186.3 billion. So that was the guidance from the company as well. So once again, we had 181.5 to 188.5 billion in revenue guidance versus 186.3 billion guidance provided by the consensus of the analysts here. Now, Apple's probably not going to provide us a guidance. They haven't really provided us any guidance since COVID started. Still citing uncertainty related to COVID. I don't know what kind of uncertainty they're facing, as most all companies are reporting guidance now. So we're still waiting on Apple earnings here. So nothing yet. I think 4:15 p.m. is when the numbers come out. So that's going to be another 7 to 8 minutes here. We're going to have to wait until the earnings come out. Oh, look at that poll. Look at that poll changing from no to yes. All you guys sneaky after the markets, after they've already reported, after Amazon's already reported, from 52% no to now 51% yes. I'm going to end the poll now before Apple numbers come out because we're going to finalize this. I'm still going to hold you guys to it. 52% said no, Apple and Amazon is not going to be able to save the market. And we'll see what happens with Apple here. Apple's the big wild card because, after hours, 5% move on a $2 trillion company is about 100 billion. 5% move on a 2 trillion is about 100 billion. 10% would have been 200 billion. 5% is about 100 billion. So for a $3 trillion company, let's see, 3 times 0.04, that's 120 billion. So if Apple drops 4%, entire Amazon's gain is going to be offset. But of course, if Apple increases, then we're looking pretty solid for the NASDAQ after hours. It is up 24 basis points. So there's some progress, a little bit coming back off of today's sell-off. But if Apple drops 4%, man, we are in some trouble here. Yeah, 992 billion, just shy of 993 billion loss on the S&P 500 today, down about 1.89%. Apple is expected to report at 4:15 p.m. Eastern, so in about 6 minutes here is when the numbers are expected to come out. Apple needs a 20% drop. Apple's going to tank only because all the big tech companies are putting money into AI and investors are hating that and just dropping out. 99% Apple misses on iPhone sales, and you know why. It's possible. I mean, there's a lot of concerns that this upgrade cycle was short of expectations. They're not producing or delivering as many iPhones as before. So it's possible that, they do miss on expectations. But again, we'll find out very soon. In the meantime, I do have the earnings release from Amazon opened up. We can take a look at that as well. But I'm going to wait to do that until after the results from Apple because I don't want to bring it up to the front page here and then cover up the charts. So we'll wait. We'll wait for Apple earnings to come out. So let's do it, Apple. Let's do it. This is about it. Again, for those of you who are joining us, consensus for Apple is about $1.60. That's what they have to beat. And revenue is just shy of 95 billion, so 94.5 billion. Amazon already reported increase across the board for operating cash flow, operating income, cloud business, advertising, and of course a beat on revenue and EPS. Guidance was within range, 186 billion expected. They guided between 181 and 188. So coming in very strongly on the guidance. And of course the revenue earnings beats as well. So all eyes are going to be on Apple now. Intel still missed expectations, but it's still up almost 13%. So that's pretty good to see. Atlassian is up 14%, which is going to be ticker symbol TEAM. They were also supposed to report today, which of course was going to be also important for that particular company. But let's see if we can find them. Sales 1.18 billion for Atlassian, versus 1.16 billion. EPS came in at 77 cents. So we got a double beat on Atlassian as well. So pretty strong numbers there. Revenue was up 21%. Subscription revenue was up 33%. This is Atlassian numbers, by the way. Ticker symbol team. Free cash flow 74 million. That's 6% free cash flow margin. And then operating loss of about 32 million. EPS negative 48 cents. That's on a GAAP basis. Non-GAAP, it was higher, 77 cents per share. Apple is looking decent, I'm gonna say. Like it's flat right now, and we can expect the numbers in about a few minutes here. Folks, if you're just joining us for the first time, do me a favor, drop a like, subscribe if you haven't already. We're almost up to 1,000 people watching. So all I'm asking is you subscribe if you haven't already, and drop a like for us if you could. It really helps out the stream, recommends it to more people, and we can grow our community to have much better discussions and more entertainment on the markets here. Still waiting on Apple here. 225 is where it's at the moment. I'm mostly interested in, of course, the iPhone revenue. That's going to be the most important piece. Earnings call for both companies starts at 5 p.m. Eastern. And don't forget, this is also going to be for the quarter ending in September. That's their last quarter of any financial year because Apple's financial year starts in October. October 1st is when their financial year starts, ends on September 30th. So this is reporting for fourth quarter. Amazon reported for third quarter, and Apple's reporting for their fourth and final quarter of fiscal year 2024. So they're now already in their financial year 2025. So we're going to get the entire numbers for the entire year. Of course, for the fourth quarter and for the entire year as well. And I'm really hoping that they give us at least some guidance as well, because that's going to help us a little bit as well in projecting what kind of expectations they have. So still waiting, nothing yet. But Amazon still up nicely, 4.6%. So Apple can really save the day here, save the market. Finally, we can peacefully sleep after a brutal $1 trillion loss in the S&P 500 here, which we haven't seen in a while, by the way. So it's kind of refreshing. It's a little bit refreshing because all we've seen really is the markets just kept on pushing up, hitting new all-time highs. 2 minutes. Yes, about 1:30 here. And yeah, just wait for... Well, I don't think Jeff Bezos is going to talk. Tim Cook's going to be there, but then Andy Jassy is going to be the one to talk under Sri. So I don't think Jeff Bezos is done. He's just... he's pretty much taken his billions and he's just partying it up, working out and partying it up at this point. So yeah, Andy Jassy should be there, and then Tim Cook's going to be there for the 5 p.m. Eastern call. So 195 for Amazon. Apple here flat, starting to make some moves up to 226 now. $1.60 in earnings per share. That's what Apple has to beat in just under $95 billion in revenues. Apple 240 plus. Oof. That would be crazy if Apple gets to 240 here. It's going to really push the market to its limit. What are we thinking, folks? It could be any second now at this point. What are we thinking? What is everybody thinking? Up or down? Up or down? Let us know in the chat. Up or down? What is it going to be? $226, 76. Still pretty flat right now. Man, it's kind of like slow and steady anticipation to the build-up here. Just slowly and steadily moving up on the 1 minute chart. No moves yet, no big moves. Just slowly and steadily kind of creeping up. We got up, 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 up. So many people saying up. Apple really taking its sweet time here. Okay, let's go, Apple. It's triangle on Intel. A lot of people saying up, up, up we go. Down, few downs coming in. Apple hitting 240 for sure. Okay, revenue came in at $85.78 billion. No, this is actually, my bad. Hold on. $1.40. Why does it say $1.40 here? Hold on, let me confirm this. I don't think this is it. They're really delaying their numbers here. Why? Yeah, that's so weird. I don't think they're reported yet, but I'm just seeing like all the third quarter numbers being trending on Twitter. Like, I don't understand why. No move on Apple yet. No move on Apple. Yeah, no move on Apple yet. I think, again, it's the fourth quarter numbers, so what they're reporting right now on Twitter is like the third quarter 2024 numbers. So it's gonna be it's gonna be a while. But yes, last quarter, the company reported $1.40 and 85.7 billion. So still pretty flat. In the Bloomberg terminal, yeah. That we do. 30 contracts on Apple for the upside. Oof. That is going to be quite the play. On the call side, I'm assuming, Kellyanne, on the call side, I always wonder who is selling at the moment in after hours, regular people, institutions, or pro traders. I mean, it's just before earnings, who can just wait for the print. Yeah, I mean, so yeah, Andy, that's the one. That's the actual third quarter one. That's not it. That's the third quarter earnings. I saw it popped up like earnings out, and then I was just kind of reading it off, but then I realized it's third quarter numbers. Third quarter, they're going to report in a few minutes here, but it's the fourth quarter for Apple. It's third quarter for everybody, most of the companies, but since Apple is on the financial year, different financial year, their financial year ends in September, starts in October, they're reporting for Q4 2024. But then, of course, Amazon was third quarter 2024 as well. Man, we got a lot of contracts on Apple. People are trading to the upside. So call side, 20 contracts. We got Sergi trades, 5 contracts on the upside for Apple. A lot of people are expecting down move. So we just got to wait a couple more minutes. But Intel still pushing. Up 15% right now, 24.85. Luca, thank you so much. I might just take you up on that offer. Just definitely please do reach out to me. And we can arrange something. If they hit 250, I'm going on vacation. Man, 250 is crazy. I don't think Apple is going to be 250. Nvidia's got that level of volatility, but you know, for Apple to get a 250 here from these levels, that's a 11% move. I mean, when was the last time you saw Apple up 11% in one day? Like, come on, 11% in one day was just it's just unrealistic altogether. Do we get the guidance during the call, George? It depends. Like for most companies, they do provide the guidance during the earnings report and then give a little bit of color on the earnings call. But Apple doesn't give us a very specific guidance. They usually say, mid-teens or low teens or mid-single digits, high single-digit growth or something very similar to what we saw this year. Like they use that kind of language, which is not very specific, but kind of fits the criteria of providing some guidance or some forecast. So yes, Apple is not... what was Intel's print? Negative 46 cents in earnings per share, and revenue came in, I think, just under 12 billion when I was checking. So, yeah, double miss, and the stock's still up. right now. We're gonna dive in deeper into these numbers. Apparently, they provided some better guidance for future quarter, and as a result, it was higher after hours. Still up 15% right now, trading back up to 24.66. So far, I mean, Intel obviously, not that it matters too much to the market. It's 92 billion market cap. Amazon doing pretty well, up 4% still, and we're really just waiting on Apple here, which should report in the next few minutes. And other than that, I don't think we had any major earnings that were scheduled for today. Tomorrow, we've got two big energy companies. So if you come over to the market calendar, we've got companies like Exxon, Chevron. They're the ones reporting tomorrow that I think are going to be super important for the energy sector and what oil does and what the expectations are from their perspective in terms of guidance. So, yeah, Intel there, 40 to 70 days is reasonable. Apple will be down because of low forecast. Why do they use that language? I mean, I don't know. They haven't really provided any specific guidance in over 3 years now, or over 4 years. They have really just not been that specific of a company to provide us any guidance. December holidays plus Black Week plus Cyber Mondays coming. Apple will do fine next quarter. Yeah, so that's always been like the year. Q4 has always been a very strong year for Apple and for most companies. I mean, Amazon has their Prime Day. Apple has, a lot of sales. Cyber Monday, of course, all technology products. Black Friday, Thanksgiving, a lot of those things are coming up. So Christmas, New Year's, we got a lot of sales happening at that time. And as a result, you'll notice for most of these companies, if you come take a look at quarterly numbers, I can show you for Apple and Amazon, both companies, but on the fundamental basis, if you come over to quarterly numbers, so last 16 quarters, you'll see a big spike in revenues during the fourth quarter, always. That's the December quarter right there. And then it kind of drops off in January. So you can see how every single year we see a nice little spike in the fourth calendar quarter, which is the first financial quarter for Apple, and then it drops off. Same thing is true for Amazon as well, right? Almost identical. You can come take a look at this, and we go over to fundamental analysis, go over to revenue, and you see a nice little pop in the December quarter, and then it drops off after that. But I mean, just Amazon's just phenomenal. You take like last 20 quarters here, every single year they've just been trending upwards, doing very, very solid, very good in terms of that growth rate for Amazon. Yeah, which they are reporting at 8:30 or 20:30, which is 4:30 p.m. Eastern, and then 1:30 p.m. Pacific, which is going to be about 4:30 p.m. Eastern and about 12:30 a.m. in Dubai. So, yeah, we'll see. We'll see how important they end up being once they report these numbers. Can they keep the markets up? Here we go. Just a couple more minutes here. 5 minutes. 70 days for 20% on Apple. Yeah, I mean, see, that's the thing. Like, Apple is, 3.5 trillion. 20% is going to be about, $700 billion. That's a lot. Where is $700 billion going to come from on Apple stock, which, already trades at a pretty expensive valuation? So I think, yes, it's got, it's still going to perform well. I mean, this year it's up like 20%. It's kind of underperforming the S&P 500 right now. But, to say like 250, 240, it's like a 10 to 11% move. Yes, over longer time frames, it's very much possible. But again, it's just really about the amount of liquidity that's going to drive the stock. NVIDIA, surprisingly, is incredibly volatile. I mean, despite trading at almost similar market caps to Microsoft and Apple, continues to be trading like a penny stock. Like almost every day, it's like down 4%, up 6%, down 10%, up 12%. And even Tesla, I mean, these Tesla and NVIDIA never trade like an actual large cap company. They always trade like there's just some small penny stock. Up, down like multiple, like 10, 12, 15 percentages in a day. Like Tesla last week was up like 27%, 22%. Crazy. Sergio, bro, run a poll for me. If I buy Apple shares, will go down. Should I buy or hold on? My guess is Apple is breaching $4 billion with NVIDIA by end of the year, followed by a humble correction. Breaching 4 trillion, you mean, Thomas? 4 billion is just like one 10 minutes worth of work. Yeah, NVIDIA has more interest for sure. NVIDIA has more interest. It's got more volatility around it. It's got a beta of 2.9, almost 3, which of course Apple is trading on a really low beta, right? We're talking less than 1. It's like on par with the S&P 500 right now for Apple's beta. Bundy, well, not really. I know that institutions don't really care much about whether retail makes money or loses money. So that's why, we encourage everyone to be just completely cold when it comes to trading the markets and really not focus too much on the emotional aspect to it and let numbers and math drive your decision making. That's why we try to quantify, as many of our decisions as possible by using the Money Invest Index, by using volatility, by using market breadth, by using, fair value assumptions and calculations to really take all the emotional aspect out of it. There's still some qualitative analysis piece that you have to run through where you have to understand the company's story. What are they building? Do you see potential? What does your gut say? What do your instincts tell about that company? But other than that, let the numbers make most of your trading investing decisions, in my opinion, because that way you can really understand the numbers inside out and not worry too much about what your emotions are telling you. So Karthik, I've been using Money Invest platform to run AMD valuation, and I just don't understand another valuation options on Money Invest platform. Justify current price, always fair value, way below $100. What's your fair value? So you can check it on the shopping list, Vault. It should be there. I think that's probably because of the GAAP versus non-GAAP expectations. Are you doing like an autofill or something? That might be the reason why it may come off as something lower than what the actual price is. But run the analysis using the non-GAAP numbers reported by AMD, analyzing them for the entire year. So, obviously it's not like you can just plug and play autofill and find it. It's going to work for most companies, but for some companies where there's like a one-off charge, you may have to spend a little bit extra time in putting your own values in and your own multiples in to better understand what makes sense or not. So, okay, Apple here now is officially up almost 1% at the moment. And we're just waiting on the earnings here. 227 is where it's at. Just 1 minute left. One more minute for Apple's earnings to come out. Yes, autofill, bro. Yeah, so if you want to plug in your own numbers, then it should be a lot better. You can get a much better idea, much better sense of what those numbers are. Intel is going to be reducing headcount by, looks like 16,000. That's, again, a lot of people. A lot of people getting laid off. And that could be the bigger catalyst other than earnings or revenue for the company, right? Because everybody loves a cost-cutting measures taken by companies. Wall Street seems to love it. So Vault, how should I spot when I should use autofill when the valuation is way off the current price? What is the red flag here? Oof, a big drop in Apple right now. Starting to roll over. Let's just break down. Let's see what the numbers look like. I'm just waiting. I feel like this dip could get bought up here. Okay, 97 cents per share. That's a huge reduction there. Are these right? 94.9 billion. We had Apple come in at revenues of 94.9 billion. EPS came in at 97 cents. 97 cents. Versus $1.60? Interesting. That's very, very interesting there. Very volatile right now. But yeah, miss on EPS. Looks like a beat on revenue. Apple, what did you do? Did you not buy as many shares this last quarter or what? Yeah, 97 cents is a big drop. I'm really curious to see what exactly was the mishap there. Just under $1 in earnings per share. Miss on expectations. The revenue came in at just over 94.4. So beat on revenue. Looks like a massive miss on EPS from the company. The stock's starting to move higher now. So 229, even despite the EPS miss, it's pushing up. It is right now up over 1.5%. Could be like a sympathy trade, folks. Could be like a sympathy or a pity trade because the markets were down so much. Traders could step in to be like, you know what, it's okay, we're just gonna buy this anyway, so that the markets can be higher. But let's see. It's really volatile right now, that's for sure. So okay, EPS, adjusted EPS $1.64. This might be a gap EPS. So yeah, $1.64 is the EPS right now. It looks like a beat. There's two different reports flirting around on Twitter. Really, really weird. $1.64, 94.9 billion. So looks like we do have a double beat. The first one came out EPS 94 cents or something. And now looks like it has a $1.64 in earnings beat there. It is EPS beat, double beat there for the company. That's like a big, wild difference there from what was being reported. So yes, $1.64, folks. Everybody's joining us for the first time here. $1.64 in earnings per share. Revenue $94.9 billion. Double beat. Stock's flat. Stock's flat right now. It's not really doing much. 47 basis points right now. I'm gonna open up the numbers as soon as they become available on investor relations. Still nothing yet. Still nothing yet. Yeah, nothing yet, but a dollar beat, $1.64 earnings per share. Revenue just shy over 94, just shy of 95 billion. So we got a double beat there on EPS. So Apple here slightly down 1.3%. Amazon still hovering over 4% higher. But we'll see if the guidance is strong enough. We've got the earnings call starting in about 30 minutes here for Apple. So we'll mostly be gearing up for Apple's numbers. So there we go. That's the 2024 press release from Apple. We're going to come over to the PDF. And this is the quarter ending in September. Let me just double check here. Fourth quarter. Got to go back. $2024. They still haven't reported yet. Still haven't reported the numbers on their 2024 stream, their page. But I do have the numbers here. iPhone revenue, $46.2 billion. So here is all of the numbers that we can find so far. EPS $1.64, down 33% year over year versus $1.49 expectations. So we got a nice beat there. Revenue $94.9 billion versus $94.3 billion, up 6% year over year. China revenues coming in at $15.03 billion for China revenues versus expectations of 15.8. So we got a slight miss on China revenue, beat on EPS, beat on revenue. Segment revenue when it comes to iPhone, $46.2 billion versus estimated $45 billion. So there's a beat there in iPhone, 5.5% increase year over year. Product revenues are shy of $70 billion, 69.96 versus 69.15 billion, expected up 4.1%. And then we got services at 24.97 billion. So these are good beats. These are still pretty decent beats. Services, they were off, still up 11.9% year over year, but just coming off a little bit. The expectations are 25.27 and matching expectations on the MacBook. Gross margins, $43.88 billion, up 8.5% year over year. Operating cash flow nearly $27 billion. Total operating expenses up 6.2%. Net income $14.7 billion. America's revenue was $41.66, up 3.9%. Europe revenue $24.9. And Apple is slightly down right now after hours, 1.6%. So not a big sell-off, but a small sell-off here for Apple, as Amazon, of course, still rallies 4%. We'll see if earnings are going to be strong enough for Apple to move back higher or for Amazon to move back down. But so far, we've got a nice move on Amazon to the upside, and of course, a little bit of a decline on Apple there. So there we go. We've got the press release and the financial statements for the fourth quarter ending in 2024. So 12 months, we got 294 billion. So we actually did see the product revenue decline on a year-over-year basis for Apple. Services increased to 96.1 billion. That's up from 85.2. And total revenues were just shy of 392 billion. So 391 is where we are, and 383 for same time last year. Gross margins, 180 billion. That's significantly higher because of the higher contribution margin from services, right? That's why gross margins are up. 43.8 billion for gross profit, and operating expenses 14.2 billion for this quarter, and 57.4 billion for the entire year. And finally, net income, which is the bottom line, a little bit over 93.7 billion. So net income was actually down, and so was earnings per share on a year-over-year basis. So, we actually we actually did see net income go down on a year-over-year basis. So again, September 28, 2024, 12 months ending, net income was 93.7 billion versus last year of just under 97 billion and 14.7 billion. So yes, 97 cents per share. So the number that was reported earlier was the actual GAAP number at 97 cents in earnings per share for the company. And these are, again, the geographies. China, 15 billion, on par with same time last year, but a significant decline from same time last year, from 72.5 down to 66.9 billion. Americas, 167, slight increase on a year-over-year basis. Japan, 25 billion, slight increase on a year-over-year basis, and most of that growth coming from rest of Asia Pacific, from 6.3 to 7.3 billion. So most, a little bit over $1 billion in increase year-over-year for rest of Asia and Pacific. Yes, Anushri, I will be live for the earnings call as well, which starts in about 20 minutes here. iPhone, slight increase year over year. 46.2 billion for iPhone this quarter. MacBook, 7.7 billion. And iPad, 6.9. And services, 24.9. So those were the numbers there. Balance sheet, let's take a look. Cash and cash equivalents sitting at 29.9 billion. So pretty much same as last year. Marketable securities, 35.2. On non-current assets, marketable securities are 91 billion. So that's slightly down from 100 billion same time last year. Some of it went to property, plant, equipment, 45.6. Total assets still did increase. A majority of that gain coming from other non-current assets from 64 to 74. That's a $10 billion increase. But inventory levels also increased. Man, that inventory level increase is actually interesting as well, right? Because you've got over almost $1 billion increase in inventory. So that's again a lot of products sitting on the shelves there. Total liabilities also increased substantially. We got 145 increasing to 176. Total liabilities increasing from $290 to $308 as their term debt went down. But it did come into their current liabilities from 9.8 to 10.9. So a little bit over $1.1 billion coming in. Accounts payable, they've got more bills, about $6 billion more bills, and other current liabilities also increasing by over $20 billion on a year-over-year basis. Now, coming over to cash flow, a couple things that I'm really interested in is the purchase of marketable securities. So $48 billion worth of purchases this past year. And then if you take a look at financing activities, purchase of common stock, 94, almost 95. I think this might be a record year for Apple buying back shares. $95 billion of share buyback from Apple. That's the most we have ever seen from the company. Last year was 77.5 billion, but this year coming in at over 94, almost $95 billion in cash buybacks. Okay, so this was the adjustment. Provision for income taxes and income before provision for income taxes, like net income sitting at just under $25 billion. And as a result, this was the GAAP versus non-GAAP. So the original screenshot that I showed you guys, the 97 cents per share, that was also correct. However, that was on a GAAP basis. Non-GAAP basis, we're sitting at about $1.64, which of course was the beat on the earnings against $1.60. That was the expectations. And we are sitting at about $1.64 in earnings per share. That is after the non-GAAP adjustment there. So beat on EPS, beat on revenue. All the segment highlights we broke down earlier, and Apple is just down about 1.4%. But we'll see if that changes after the earnings. But Amazon still pretty green. Intel's up over 10%, and QQQs, they were green in this first couple candles here in the 15 minutes that Amazon reported their numbers. And now we're back down to pretty much flat right now, because if Amazon pushes up 4%, Apple down 1.5%, that comes off to being pretty much offsetting Amazon's gain there. So Apple will do well going forward. Recent M4 hardware and forthcoming iPhone SE releases. Yes, so new MacBooks came out with the M4. And of course, that was presented on Apple's YouTube channel. I watched that video as well. And look, I'm also looking at upgrading my MacBook, right? It's 4 years old, and it's an M1 chip, really, really old. But I think it's time for M4 now. And, Apple's business now is going to be changing significantly moving forward, because services, I think, is going to make up for, I think, a bigger and bigger portion of their revenue. I mean, we're already starting to see that, because last year, if you do the math, $383 billion of revenue, right? And if you do the math here, let's say 85 divided by 383, we're looking at a contribution margin of 22%. 22% was the contribution margin for services. Compare that to this year, 96 divided by 391, we're looking at 24.5. So services as a percentage of revenue has increased by 2.5% for Apple on a year-over-year basis. Hence, the margins are increasing. Because if you take a look at gross margins last year, 169, right? 169 divided by 383, we're looking at 44.1%. Gross margins this year, 180 divided by the total revenue of 391, it's 46%, right? So that's also a 190 basis point increase, or 1.9 percentage points increase in gross margins for Apple. Why? Services. Services has always been the growth piece for Apple. And a lot of these devices are nothing but an install base, and services is where a lot of that money is going to come from, with higher margins, because services is literally one of the highest margin offerings from Apple. Because take a look at the gross margins for services. 25 billion incurred on a 96 billion revenue. So 25 divided by 96, that's a 26% cost of revenue, meaning there's a 74% gross margin. 74% gross margins on services versus product. 185 divided by 294, 62% is the cost. That means 38%. 38% is the gross margin for Apple on products versus 74% on margins on services. So services is the answer. If anybody's really long-term growth oriented on Apple, services is the main key there, because as the contribution margin increases, margins will increase and the bottom line will also go up for the business. So, that right there is one of the main reasons why we're seeing net income, gross margins, and of course revenue increase very, very well. Margins is going to be the main reason. So, okay. So non-GAAP adjustments to provision for income taxes and net income reflect the impact of a reversal of European General Court State Aid decision recognized during the fourth quarter of 24. On September 10th, the European Court of Justice announced that it had set aside the 2020 judgment of European General Court, confirmed the European Commission's 2016 state aid decision, and the company recorded a one-time income tax charge of $10.2 billion. So that was a one-time income tax charge they're going to add back, because they're going to realize that, and that's one of the reasons why once it's added back, their non-GAAP EPS is about $1.64. So that's the non-GAAP adjustment. And look, non-GAAP and GAAP, really the difference is GAAP, of course, is the generally accepted accounting principles. You have to account for every type of expense that you incurred. So that's why if a company is paying out stock-based compensation, even if it's a non-cash expense, they can account it under GAAP principles to lower their taxable income, thereby paying lower taxes. But non-GAAP, you can pretty much remove all those non-cash expenses and report, of course, a higher net income because it's not really cash leaving the business. It is non-cash expense. Same as depreciation, amortization. A lot of companies would write off buildings, property, plant. They will depreciate them to lower their taxable income under GAAP principles so that they have to report less earnings and of course, give out less in taxes when it comes to corporate taxes. So non-GAAP equals cooking the books. Well, yeah, I mean, in some cases you can make a lot of adjustments to this, but at the same time, if one better than the other, really depends on who you ask. But I do prefer, like, if you were to strip out a lot of those non-cash expenses, you get to the true profitability of the business. So yes, you may argue that non-GAAP may not be the best way to look at it, but I do prefer non-GAAP more than GAAP because under GAAP, you're not really getting the true profitability of the business because the company can write off depreciation, stock-based compensation, and then show up huge amounts of expenses when in reality, they haven't really incurred all those expenses and the margins might be higher, income might be higher, so on and so forth. So, but then of course, you have to look at what kind of income they're really adding back in non-GAAP. If they're really adding back some unusual items, then you're going to have to be very, very careful in those numbers as well. But yeah, all in all, I mean, Apple here down 1% so far, and we've got Amazon still up 4%. Now, the real question is, are we listening to Apple or Amazon's earnings call? What are we going to be listening to? So let's just do a very quick poll. Earnings call live, Apple, Amazon. Which company earnings call are we going to be listening to? Really important question, folks, because we can only really listen to one because they're both happening at the same time, I believe. So Apple is starting at 5 p.m. Eastern, 2 p.m. Pacific, and Amazon's also going to be around the same time. So, wow, there's surprisingly more people for Amazon than there are for Apple. Amazon will be the most to move. Amazon. Wow, Apple is boring. Okay. I guess, well, it's 50-50. Come on, folks. Don't do it 50-50. I don't want to have to be the one to make a decision here. Please decide among yourselves. Come up to a majority here. By the way, I lost a comment here. Guess who made plus 30% in a week? Gamble out of these earnings. Tesla, Amazon, Google. MJ Fitness and Health, thank you so much for the donation and congratulations on those wins. Absolutely incredible. Very, very strong. 100 votes and 50-50. Come on, folks. Make up a majority here so we don't have to piss anybody off. Apple matters more. Yes, Apple does matter more. Amazon's going to be more volatile. So it's 52-48 right now. So look, Amazon, I feel like is going to be a little bit more important because of the retail aspect to it. They've got much better trends on consumer spending, which can relate better to where where the economy is headed in terms of a recession or not, and what kind of consumer spending habits they're seeing from their guidance as well. Apple's also going to be more important because they're kind of at an inflection point where they're not seeing as strong as upgrade cycles as before. The new iPhone launch, the 16, the 16 Pro. Man, come on, folks. Don't do it 50-50. You guys are going to keep it at 50-50, aren't you? Oh. Man, 179, 181 votes, and we're literally 50-50 right now. I don't want to be the bad guy here. I really don't want to be the bad guy here. Apple has a dividend, as if that makes all the sense in the world. All right, I've got them both opened up here. I haven't made a decision yet, but which is more important to you? Well, I have a position in Amazon, but it's not substantial, and I don't have any positions in Apple. I have, of course, VUG, which is the market ETF. So if you ask me, like, I'd be fine with both of them. I'd be fine with both of them, honestly. But just be the bad guy. Executive call. Why don't we flip for it? Yes, why don't we flip a coin for it? If it's 50-50, 5 minutes prior to the earnings, then we'll flip for it. Okay? Deal? Amazon and you're the good guy. Yeah, I'm the bad guy for 47% people that are voting for Apple. If it's 50-50, in the next 5 minutes, do Intel. Screw Apple, screw Amazon, we're listening to Intel. That'd be crazy. I'd not just be bad for half the people, I'd be bad for everyone right now. Yeah, so if you're 50-50 in the next 5 minutes or so, like a couple minutes before the earnings, then we're flipping for it. Okay? So, which one are we giving heads to? Heads to Tim and tails to Andy Jassy. If it's 50-50 though. Right now it's 49-51. So this is not it. This is not it. We haven't flipped yet. We haven't flipped yet. We still have to decide whether Apple is going to be heads, tails, Amazon, which one. But if it stays 49-51 here, it looks like we're still going with Amazon here. If it stays this way. Whatever happens in the next couple minutes. 49-51. Intel is going to be way more entertaining. Come up with reasons here. Let's see. Come up with reasons on why we should be listening to Apple or Amazon. So 49-51, 279 votes. We got over 800 people watching, folks. Definitely, oh my God, back to 50-50. Do participate in the poll here. I'm going to close it in 2 minutes. 2 minutes, I'm closing that poll. And if it stays 50-50, then I am flipping a coin. Flipping a coin is not the investor's way of deciding. Well, it's really for you guys because, like I said, I am fine with either way. Like, you know, maybe I'm slightly more inclined to Amazon than Apple, but because I'm really just interested in the consumer spending trends there. Folks, if you don't decide in the next 1 minute here, we're flipping a coin. And it doesn't look like you guys are very keen on deciding here. You really want to see that coin flip, huh? Okay, looks like it's 50-50, and we are 15 seconds away. I'm going to end the poll here. We're going to have to go with a coin flip because can't seem to decide. And we only have 5 more minutes left, so might as well just be ready for it. Okay. 50-50, we didn't have enough votes. Looks like Amazon's still beat out. Amazon's still slightly beat out towards, like, but it's like 49-50. It's very close. Okay, so heads is going to be Apple. Tails is going to be Amazon. Okay? Again, heads is Apple. Tails is going to be Amazon. Hopefully this works. I'm going to flip it now. Okay? Tails. So Amazon it is. Amazon indeed it is because it was slightly higher anyway. But tails it is. We're listening to Amazon. Sorry, Apple. It's going to start in about a couple minutes here, but there you go. Fate decided it for us. But Amazon it is. We're listening to Amazon, folks, for the earnings. Best out of 3. Best out of 3. No, it's just 1 out of 1, folks, because we only have like a couple more minutes until earnings begin. But we're gonna be looking at the price action as well. Okay, so we're gonna be looking at the price action as well. Rigged. But yeah, folks, we only can really do one at a time. So the rigged coin recount. That was fun though. That was fun. Earnings stream. So, if they weren't happening, of course, at the same time, you guys know that I'd be doing it. I'd be doing both because on Tuesday we did Microsoft first, or no, we did Google first, and then of course we did AMD towards the back half of it. But of course we can only really do one at a time. So you want to see our auditor for the flip. But yeah, Amazon it is. Should start in about a couple minutes here. Apple down a little bit over 1.3, and Amazon still up 3.3%. The real question is, can Amazon sustain these gains, after the earnings? And the guidance was pretty strong, so that's good. Now I kind of want to listen to Apple because we already know so much about Amazon. Apple doesn't really tell us much, so that creates that curiosity. But it's okay. The decision's been made. The coin has spoken. Yes, AWS got more related to AI, so that for sure is going to be important as well. So, hope you all are ready for the earnings for Amazon. George says, thanks, I have Amazon 100%. Yeah, Wigglefish, I plan to sign up for your website tomorrow. Care to do a little? This is what you get while we wait for the earnings. Sure. So basically, you get access to the entire website, right? That's part of it. You can pretty much look at the MoneyVest index. We're down to 3.3 now. 3.3 after pretty much the market's closed. Updated just a few minutes ago. 3.3 is pretty low. No, I'm not changing. The coin has spoken. We're listening to Amazon. You get the market snapshots. Get a little bit of an overview, bird's eye view of how the markets are doing. Market calendar, of course, you get the earnings and the economic calendar, as well as market concentration. And then, of course, we've added this elite investor page, which is the 13F filings for, some of the biggest investors. You got Kathy Wood, Bill Ackman, Ron Barron, Carl Icahn, George Soros, Warren Buffett. All these, you can pretty much click here and take a look at their portfolio. This will update every time you get a new 13F filing. And you can also switch between different quarters for when they've reported these numbers. You can come over to history, take a look at when exactly they made their transactions, their trades. So right now we're looking at Apple for the last 3 years. You can go over to 5 years, and you'll notice that Warren Buffett, of course, coming in with a big sale here in the second quarter 24, 389 million shares sold. So you get this, get the allocation. You can see how much it's dropped since the last quarter because of Apple's sale. You got your shopping list, and of course for individual stocks, you can do your full fundamental technical analysis on individual stocks as well. Apart from that, of course, you get the Patreon access, all the members only videos. I'm going to be posting a new video this weekend on the MoneyVest index and the historical values and why it's so important of a metric for me. And then we'll also, of course, you'll have access to all the trade alerts, Discord channel, and the options portfolio and the options portfolio updates every single week as well. That's also going to be a part of it. So Pratt says, I'm a member since 2021. Just go for it. So thank you so much, Pratt. Really appreciate you and hope you're enjoying all the content and all the value that we have here. And just let me know if you have any questions, right? So anybody, if you have any questions, please feel free to reach out. I'm always available to help. Our community is always available to help and support. Okay. Wow, that's some interesting music from Amazon. We're going to start as soon as they start speaking, and I am going to minimize this a little bit, bring up the screen for the Amazon call, minimize this a little bit as well, and we're all set. I'm going to put the Apple stock price down here because they're both going to be starting at the same time, right? So we'll see if Apple recovers a little bit. Just keep the 5-minute chart. So Justin, what's your expectation, I guess, on Apple stock? I'm currently taking a heavy blow. Well, it depends. Do you have options or actual shares? Like, what do you have exactly on Apple? And really, just like, what's your time horizon on Apple as well? That's also very important to know. One thing about what you were just showing is please change the pull down menu with the stocks of investors, because for long lists you can't really find anything. Well, do you mean the elite investors, and then when you go to a specific investor, like something like this, and the list is not sorted A to Z? So this one right here, I think this is sorted by market cap, or market value, I should say. That's, I think, the assortment for them. And I'm a long-term investor, so in that case, okay, hold on.
Exchange rates, changes in global economic and geopolitical conditions, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $158.9 billion. 56% year over year, and trailing 12-month free cash flow adjusted for equipment finance leases was $46.1 billion, up 128% or $25.9 billion year over year. As always, we're focused on making our customers' lives better and easier and thinking long-term with respect to how we can keep helping customers and build a successful business that outlasts all of us. In our stores business, we saw sales growth of 9% year over year in the North America segment and 12% year over year in the international segment. Our team continues to focus on the inputs that matter most to customers: really broad selection, low prices, fast and free delivery, and a range of compelling Prime member benefits, including our recent additions of unlimited grocery delivery from Whole Foods Market, Amazon Fresh, and local third-party grocery partners for $9.99 a month, and fuel savings of 10 cents a gallon at BP, Amoco, and AMPM stations in the U.S. At a time when consumers are being careful about how much they spend, we're continuing to lower prices and ship even more quickly, and we can see this resonating with customers as our unit growth continues to be strong and outpace even our revenue growth. In the last few months, we've hosted our largest and most successful Prime Day and Prime Big Deal Days ever, and helped customers save over $5 billion across more than 50 million deals. And for the second year in a row, we are on track to deliver at our fastest speeds ever for Prime members globally. We also continue to focus on lowering our cost to serve and are pursuing several initiatives that we believe will have meaningful long-term impact in this area. First, we continue to believe there are more gains on top of what we've captured thus far in outbound regionalization and getting more items closer to end consumers. As such, we're in the process of significantly changing the way we inbound items into our fulfillment network and subsequently spread them to our regional fulfillment nodes. In the last few months, we've made hundreds of changes to our U.S. inbound network and opened more than 15 inbound buildings. While it's still relatively early in this re-architecture, we've already improved our ability to spread inventory across our fulfillment centers by 25% year over year, allowing us to have more of the requisite items in fulfillment centers closest to the customer so we can compile shipments and ship to customers even more quickly. As we scale and optimize this new design, we expect these changes will further improve inventory placement, offer faster delivery times, save transportation costs, and enable us to increase units shipped per box. Second, we continue to roll out same-day delivery facilities, which is not only the fastest way to get products to customers, but also one of our lowest cost ways to deliver. Over 40 million customers this past quarter have had their orders delivered for free with same-day delivery, an increase of more than 25% year over year. And third, we continue to innovate in robotics to speed delivery, lower cost to serve, and further improve safety in our fulfillment network. We recently launched our 12th generation fulfillment center design, with the first building launching in Shreveport, Louisiana. This is the first facility that incorporates our newest robotics inventions that simplify stowing, picking, packing, and shipping processes. Thus far, this new design reduces fulfillment processing time by up to 25%, increases the number of items we can offer for same-day or next-day delivery, and is expected to drive a 25% improvement in our cost to serve during peak within this next-generation facility. Though we believe we have more expansive automation and robotics than other retail peers, it's still early days in how much automation we expect in our fulfillment network. In advertising, we remain pleased with our progress, generating $14.3 billion of revenue in the quarter, 18.8% year-over-year growth. Our expansive reach, ability to surface relevant offers to our customers, opportunity to engage customers from the top of the funnel to point of purchase, and leading capabilities around measuring outcomes at every touch point provide all types of brands with full funnel advertising at scale. With sponsored products, we're seeing meaningful growth on a very large base, and we see further opportunity in driving even better performance for advertisers by further improving the relevancy of the ads we show and by providing additional optimization controls. At the same time, some of our newer offerings are in their very early days. We're just entering our first broadcast season for Prime Video advertising, following a very strong showing at Upfronts. And we're continuing to support brands of all sizes with our generative AI-powered creative tools across display, video, and audio, including our video generator that uses a single product image to curate custom AI-generated videos. While we're generating a lot of advertising revenue today, there remains considerable upside. AWS grew 19.1% year over year, and now stands at a $110 billion annualized run rate. We've seen significant re-acceleration of AWS growth for the last 4 quarters. With the broadest functionality, the strongest security and operational performance, and the deepest partner community, AWS continues to be customers' partner of choice. There are signs of this in every part of AWS's business. We see more enterprises growing their footprint in the cloud, evidenced in part by recent customer deals with the AMZ Banking Group, Booking.com, Capital One, Fast Retailing, Itaú Unibanco, National Australia Bank, Sony, T-Mobile, and Toyota. You can look at our partnership with NVIDIA called Project Seba, where NVIDIA has chosen AWS's infrastructure for its R&D supercomputer, due in part to AWS's leading operational performance and security. And you can see how AWS continues to innovate in its infrastructure capabilities with deliveries like Aurora Limitless Database, which extends AWS's very successful relational database to support millions of database writes per second and manage petabytes of data while maintaining the simplicity of operating a single database. Or with our custom Graviton 4 CPU instances, which provide up to nearly 40% better price performance versus other leading x86 processors. Companies are focused on new efforts again, spending energy on modernizing their infrastructure from on-premises to the cloud. This modernization enables companies to save money, innovate more quickly, and get more productivity from their scarce engineering resources. However, it also allows them to organize their data in the right architecture and environment to do generative AI at scale. It's much harder to be successful and competitive in generative AI if your data is not in the cloud. The AWS team continues to make rapid progress in delivering AI capabilities for customers and building a substantial AI business. In the last 18 months, AWS has released nearly twice as many machine learning and Gen AI features as the other leading cloud providers combined. AWS's AI business is a multi-billion-dollar revenue run rate business that continues to grow at a triple-digit year-over-year percentage and is growing more than 3 times faster at this stage of its evolution as AWS itself grew. And we felt like AWS grew pretty quickly. We talk about our AI offering as 3 macro layers of the stack, with each layer being a giant opportunity, and each is progressing rapidly. At the bottom layer, which is for model builders, We were the first major cloud provider to offer NVIDIA's H200 GPUs through our EC2 P5e instances. And thanks to our networking innovations like Elastic Fabric Adapter and Nitro, we continue to offer advantaged networking performance. And while we have a deep partnership with NVIDIA, we've also heard from customers that they want better price performance on their AI workloads. As customers approach higher scale in their implementations, they realize quickly that AI can get costly. It's why we've invested in our own custom silicon in Trainium for training and Inferentia for inference. The second version of Trainium, Trainium 2, is starting to ramp up the next few weeks and will be very compelling for customers on price performance. We're seeing significant interest in these chips, and we've gone back to our manufacturing partners multiple times to produce much more than we'd originally planned. We also continue to see increasingly more model builders standardize on Amazon SageMaker, our service that makes it much easier to manage your AI data, build models, experiment, and deploy to production. This team continues to add features at a rapid clip, punctuated by SageMaker's unique HyperPod capability, which automatically splits training workloads across more than 1,000 AI accelerators, prevents interruptions by periodically saving checkpoints and automatically repairing faulty instances from their last saved checkpoint, and saving training time by up to 40%. At the middle layer, where teams want to leverage an existing foundation model customized with their data, and then have features to deploy high-quality generative AI applications, Amazon Bedrock has the broadest selection of leading foundation models and most compelling modules for key capabilities like model evaluation, guardrails, RAG, and agents. Recently, we've added Anthropic's Claude 3.5 Sonnet model, Meta's Llama 3.2 models, Mistral's Large 2 models, and multiple stability AI models. We also continue to see teams use multiple model types from different model providers and multiple model sizes in the same application. There's muck and orchestration required to make this happen, and part of what makes Bedrock so appealing to customers and why it has so much traction is that Bedrock makes this much easier. Customers have many other requests, access to even more models, making prompt management easier, further optimizing inference costs, and our Bedrock team is hard at work making this happen. At the application or top layer, we're continuing to see strong adoption of Amazon Q, the most capable generative AI-powered assistant for software development and to leverage your own data. Q has the highest reported code acceptance rates in the industry for multi-line code suggestions. The team has added all sorts of capabilities in the last few months, but the very practical use case recently shared, where Q Transform saved Amazon's teams $260 million and 4,500 developer years in migrating over 30,000 applications to new versions of the Java JDK, has excited developers and prompted them to ask how else we could help them with tedious and painful transformations. Spend a few minutes reading developer forums about what they wish they could move away from, and you'll get an idea of what they want. Expect more practical AI game changers from Q. We're also using generative AI pervasively across Amazon's other businesses, with hundreds of apps in development or launched. For consumers, we've expanded Rufus, our generative AI-powered expert shopping assistant, to the UK, India, Germany, France, Italy, Spain, and Canada. And in the US, we've added more personalization, the ability to better narrow customer intent, and real-time pricing and deal information. We've recently debuted AI shopping guides for consumers, which simplifies product research by using generative AI to pair key factors to consider in a product category with Amazon's wide selection, making it easier for customers to find the right product for their needs. For sellers, we've recently launched Project Amelia, an AI assistant that offers tailored business insights to boost productivity and drive seller growth. We continue to re-architect the brain of Alexa with a new set of foundation models that we'll share with customers in the near future, and we're increasingly adding more AI into all of our devices. Take the new Kindle Scribe we just announced. The note-taking experience is much more powerful with the new built-in AI-powered notebook, which enables you to quickly summarize pages of notes into concise bullets in a script font that can easily be shared. Speaking of Kindle products, we just launched a completely new Kindle lineup, the first time we've done a portfolio refresh of this size. Apart from the Scribe, it includes the first ever color Kindle, the fastest Kindle Paperwhite ever, and a new pocket-sized Kindle. The early sales for these devices have significantly outperformed our expectations, and Kindle is having an excellent year with customers reading more than ever. We now have over 20 billion average monthly pages read on Kindle devices worldwide. There are so many things we're energized by right now, but we'll quickly mention one more, the progress we're making in improving customers' pharmacy experience. Brick-and-mortar pharmacies account for just over 90% of prescriptions dispensed in the U.S., but require customers to make trips to forlorn physical venues with much of the selection behind locked shelves, wait in lines for meds, and only find out about pricing at the point of purchase. The largest mail-order pharmacies offer deliver in 5 to 10 business days. We think customers deserve better. Today, we can deliver to 95% of first-time Amazon pharmacy customers in the U.S. within 2 business days, and to 20% of U.S. Prime members within 24 hours. Next year, we plan to launch operations in 20 new cities, so nearly half the U.S. will have the ability to have their medications delivered to their door within hours. We believe making it easier for customers to get their medications will improve medication adherence, which we know can directly improve health outcomes. Across Amazon, we have a lot coming in the next few months. We eagerly look forward to sharing these with customers, and a big thank you to my Amazon teammates around the world for all their hard work. And with that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Let's start with our top-line financial results. Worldwide revenue was $158.9 billion, an 11% increase year over year, excluding a 20 basis point unfavorable impact of foreign exchange. As a reminder, our Q3 guidance had anticipated a larger unfavorable impact of approximately 90 basis points. Worldwide operating income increased 56% year over year to $17.4 billion, our highest quarterly operating income ever, and was $2.4 billion above the high end of our guidance range. We remain focused on streamlining and managing costs in a way that allows us to continue inventing for customers in a cost-effective way. In the third quarter, North America segment revenue was $95.5 billion, an increase of 9% year over year. International segment revenue was $35.9 billion, an increase of 12% year over year. Worldwide paid units accelerated to 12% growth year over year as our customers continue to come to Amazon for low prices, broad selection, and convenient, fast delivery. Prime remains a core contributor to this growth. Year-over-year paid membership growth accelerated in Q3 for both the U.S. and globally, helped by our 10th annual Prime Day event in mid-July. Customers are enjoying even faster delivery speeds, which also helps drive strong growth in items like everyday essentials. This includes items like health, beauty, and personal care, as well as non-perishable grocery. And while these items often have a lower average selling price, the strength in everyday essentials revenue is a positive indicator that customers are turning to us for more of their daily needs. We see that when customers purchase these types of items from us, they build bigger baskets, shop more frequently, and spend more on Amazon. We remain focused on keeping prices sharp and offering broad selection that gives customers options when making purchase decisions. Shifting to profitability, our North America and international segments each delivered their 7th consecutive quarter of year-over-year operating margin improvement. North America segment operating income was $5.7 billion, an increase of $1.4 billion year over year. North America operating margin was 5.9%, up 100 basis points year over year. In the third quarter, we continued to make progress in improving our fulfillment network cost structure, driven in part by improved inventory placement. This helped us drive better productivity in our transportation network and shipping efficiency from higher units per box. In the international segment, operating income was $1.3 billion, an improvement of $1.4 billion year over year. International operating margin was 3.6%, up 390 basis points year over year. So far this year, we've generated operating profit in each of the 3 quarters for the international segment and totals $2.5 billion year to date. We're seeing strength in our established countries like the UK and Germany as we continue to drive efficiencies to improved on-road productivity in our transportation network and better execution in our fulfillment centers. Our emerging countries are growing revenue at a healthy rate also, and they are leveraging their cost structures while investing strategically in prime benefits. We have confidence that our focus on the inputs, coupled with the strength of our global teams, will continue to drive improvement over time. Advertising remains an important contributor to profitability in the North America and international segments. This quarter, we saw strong growth on an increasing large base of advertising revenue. We see many opportunities to further expand our ads offering in areas that are driving growth today, like sponsored products, as well as more recent growth areas like Prime Video ads. Moving next to our AWS segment, revenue was $27.5 billion, an increase of 19.1% year over year, excluding the impact of foreign exchange. AWS now has an annualized revenue run rate of $110 billion. The business continues to grow, and we see opportunity to expand our core cloud offering and our AI services. Customers increasingly recognize that to get the true benefit of generative AI, they also need to move to the cloud. AWS operating income was $10.4 billion, an increase of $3.5 billion year over year, and as a result of our continued focus on cost control, including a measured pace of hiring, a focus on driving efficiencies on our infrastructure, and reducing costs across the business. Additionally, we increased the estimated useful life of our servers starting in 2024, which contributed approximately 200 basis points to the AWS margin increase year over year in Q3. As we've said in the past, we expect the AWS operating margins to fluctuate, driven in part by the level of investments we're making at any point in time. Now turning to our capital investments. As a reminder, we define these as a combination of cash CapEx plus equipment finance leases. Year-to-date, capital investments were $51.9 billion. We expect to spend approximately $75 billion in CapEx in 2024. The majority of the spend is to support the growing need for technology infrastructure. This primarily relates to AWS as we invest to support demand for our AI services, while also including technology infrastructure to support our North America and international segments. Additionally, we're continuing to invest in our fulfillment and transportation network to support the growth of the business, improve delivery speeds, and lower our cost to serve. This includes investments in same-day delivery facilities, in our inbound network, and as well in robotics and automation. We're encouraged by the start of the holiday season, which kicked off in October with a strong Prime Big Deal Days. We are ready to serve customers throughout the season, and I want to thank our teams across Amazon for delivering 2 very large Prime member events in the past 4 months, and for getting us ready to delight customers during this holiday season. With that, let's move on to your questions.
Thank you. At this time, we will now open the call up for questions. We ask each caller to please limit yourself to 1 question. If you would like to ask a question, please press star 1 on your keypad. We ask that when you pose your question, you pick up your handset to provide optimum sound quality. Once again, to initiate a question, please press star, then 1 on your touch-tone telephone at this time. Please hold while we poll for questions. Thank you. And the first question comes from the line of Doug Anmuth with J.P. Morgan. Please proceed with your question.
Thanks so much for taking the questions. Brian, I was hoping you could talk a little bit more about the drivers of the 38% AWS margins. I know you mentioned the 200 basis points related to the useful lives push out, but just how to think about sustainability, kind of in the 30s there going forward. And then perhaps related, the step up in CapEx that you saw in 3Q. You gave the full year number, which was helpful. Any kind of early read or thoughts on how we should think about 2025? Thanks so much.
Okay, thanks, Doug. Let me start with AWS. The primary drivers of the year-over-year margin increase are threefold. So first is accelerating top-line demand. That helps with all of our efficiencies, our cost control efforts, and of course, what you just mentioned, I believe, the change in the useful life of our servers this year. Let me remind you on that one. We made the change in 2024 to extend the useful life of our servers. This added about 200 basis points of margin year over year. On cost control, there's been a number of areas. It's first is hiring and staffing. We're being very measured in our hiring, and you can tell as a company where our office staff is down slightly year over year, and it's flat to the end of last year. So we're really working hard to maintain our efficiencies, not only in the Salesforce and other areas and production teams, but also in our infrastructure areas. Infrastructure is a big part of our cost structure in AWS, and we're probably the best at matching up supply and demand and driving cost efficiencies and driving those operations very strongly. And I think you saw that this quarter, especially on the higher volume. Over time, this margin will fluctuate in the segment. There's a number of factors to keep in mind, including our level of investment in the amount of innovation and product development we're doing for new products and services, changes in our staffing for sales and support organizations, and of course, capital to support customer growth and to build cost-performant chips for our customers' applications. So, as I mentioned, we do a really good job of matching supply and demand, and when you do that in this business, it can result in quarters like we just saw.
Yeah, I'll take the CapEx part of that. As Brian said in his opening comments, we expect to spend about $75 billion in 2024. I suspect we'll spend more than that in 2025, and the majority of it is for AWS, and specifically the increased bumps here are really driven by generative AI. As I was mentioning in my own opening comments, our AI business is a multi-billion-dollar business that's growing triple-digit percentages year over year, and is growing 3 times faster at its stage of evolution than AWS did itself. And we thought AWS grew pretty fast. And so the thing to remember about the AWS business is the cash life cycle is such that the faster we grow demand, the faster we have to invest capital in data centers and networking gear and hardware. And of course, in the hardware of AI, the accelerators or the chips are more expensive than in the CPU hardware. And so we invest in all of that up front in advance of when we can monetize it with customers using the resources. But, of course, a lot of these assets are many-year useful life assets. Data centers, for instance, are useful assets for 20 to 30 years. And so I think we've proven over time that we can drive enough operating income and free cash flow to make this a very successful return on invested capital business. And we expect the same thing will happen here with generative AI. It is a really unusually large, maybe once in a lifetime type of opportunity. And I think our customers, the business, and our shareholders will feel good about this long term, that we're aggressively pursuing it.
And our next question comes from the line of Ross Sandler with Barclays. Please proceed with your question.
Andy, if I could push on that last answer, you talk about how AI is about the same size but growing way faster than early AWS. And if we look back, at the market in like the early 2010s, it was hyper competitive on pricing. Your margins were below 15%, I believe, back then. And it seems like a lot of that is what's going on right now in AI with these new AI data centers, where you got competitive pricing and suboptimal utilization just in the whole industry. So as that revenue line grows from where it is today to tens of billions of dollars in coming years, how does that margin come on from the AI data centers versus your existing kind of 30+% margin at AWS? Any thoughts on how quickly you can close the gap and how that looks on the new AI workloads versus maybe this mid-30s that the core business is running at? Thank you very much.
Yeah. So some quick context, Ross. I think one of the least understood parts about AWS over time is that it is a massive logistics challenge. If you think about, we have 35 or so regions around the world, which is an area of the world where we have multiple data centers, and then probably about 130 availability zones or data centers. And then we have thousands of SKUs we have to land in all those facilities. And if you land too little of them, you end up with shortages, which end up in outages for customers. So most don't end up with too little, they end up with too much. And if you end up with too much, the economics are woefully inefficient. And I think you can see from our economics that we've done a pretty good job over time at managing those types of logistics and capacity. And it's meant that we've had to develop very sophisticated models in anticipating how much capacity we need where in which SKUs and units. And so, I think that the AI space is for sure earlier stage and more fluid and dynamic than our non-AI part of AWS. But it's also true that people aren't showing up for 30,000 chips, in a day. They're planning in advance. So we have very significant demand signals giving us an idea about how much we need. And I think that one of the differences, if you were able to get inside of the economics of the different types of providers here, is how well they manage that utilization and that capacity. It has a very direct impact on what kind of margins you have over time and what kind of capital efficiency you also have over time. And so I think you're right, Ross, that there are some similarities in the early days here of AI where the offerings are new and people are very excited about it. It's moving very quickly, and the margins are lower than what I think they will be over time. The same was true with AWS. If you looked at our margins around the time you were citing in 2010, they were pretty different than they are now. And I think as the market matures over time, they're going to be very healthy margins here in the generative AI space.
And the next question comes from the line of Brian Novak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. Hey, Andy, I have two. The first one, I feel like we talk a lot about your targets and sort of North Stars for domestic profitability. Can you talk to us a little bit about how you think about the drivers of international retail profitability from here and sort of how you think conceptually where the margins could go and what drives them there? And then the second one, I wanted to sort of ask you more about the robotics that you mentioned. I know you've been investing in robotics now for quite a few years. Where are you now in that journey, and how do we think about the next largest areas of investment in robotics in the warehouse network? Thanks.
Hey, thanks, Brian. This is Brian. Let me take the first part of that question on international segment profitability. So, if you've looked at the trends, we see quarter-to-quarter fluctuations certainly in operating profit in the international segment, but we're starting to see clear trend lines that are moving positive and above zero. And for each of the last 7 quarters, as I mentioned, we've had year-over-year improvement in op margin, and in the last quarter, operating income was up $1.4 billion versus the prior year. So, really, it is a lot of the same factors you're seeing in North America: lower cost to serve, greater contribution from advertising, improved selection, faster delivery speeds, which help drive consumer demand. And if you step back further, international is really a mix of our established countries where we've been operating for a long time, the UK, Europe, and Europe and Japan, and a number of emerging countries, including 10 new countries that we launched in the last 7 years. So there's a lot under the hood there, and there's different stories in each country. Each of them is on a different point in the path from launching to customer adoption to scaling towards profitability to then making consistent operating profits. So I think our expectations in each of those countries mirror those in North America, and we intend over the fullness of time that we're going to aim for North America margins, which are not static themselves. So we're happy with the performance. Glad to see a number above zero in many of the last few quarters, but really it's the story on a country by country basis that we're working hard.
On the robotics piece, what I would say is even though we believe we have more expansive and advanced automation and robotics capabilities in our fulfillment network than other peers, it's so early with respect to what we're going to do automation and robotics-wise in our fulfillment network. We're just at the stage right now where we're starting to roll out. We had about a 5 or 6 very significant new robotics capabilities in the areas of stowing, picking, packing, and shipping that we are have finally put into one facility to get the entire workflow. It's a facility in Shreveport, Louisiana, that was just launched a few weeks ago. And as I mentioned in my opening comments, we're seeing very encouraging results there. And of course, the reason why we're trying to have more robotics and automation in our fulfillment network is it allows us to ship more quickly, to ship more cost effectively, and to make conditions even safer for our fulfillment teammates than what they already have today. And I think something that the team has done in a very disciplined way, and I talked about this a little bit in my annual letter, my shareholder letter, is just they have been very thoughtful about defining what are the primitive foundational building blocks that you need that you can then use in lots of different combinations to build additional automation robotics capabilities down the road so that we can move even more quickly with the next generation of robotics capabilities. And that team has invested in those, and they're already working on the next generation. And the last piece I would add to that is we really do believe that that AI is going to be a big piece of what we do in our robotics network. We had a number of efforts going on there. We just hired a number of people from an incredibly strong robotics AI organization, and I think that will be a very central part of what we do moving forward too.
And the next question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks for taking the question. Maybe a two-parter if I can. Looking at the results in the commerce business, there's a clear sort of pattern emerging with respect to ASPs versus unit growth. Can you talk a little bit about what you're seeing in terms of consumer behavior and the propensity to be receptive to either lower ASP items or discounts among consumer behavior? And then the second part would be, can you talk a little bit about some of the strategic initiatives you're building for the long term around capitalizing on lower ASP items and the potential shift to more consumables in the base of consumption habits on the platform? Thanks so much.
Yeah. Hi, Eric. Thank you for your question. Yeah, you're right. Q3 unit volume was strong at 12% worldwide. It's pretty similar in North America versus international. And the consumer factors, we're seeing a continuation of many of the things we've discussed over the first or last few quarters. Customers looking for deals and are price conscious. This matches up well with our Prime events where we were, which were well received and saved billions of dollars for our Prime members. It also led to paid Prime member growth accelerating in the quarter, which is hugely impactful for us. A lot of our best offers and deliveries are tuned to Prime membership, and it's the best deal in retail. So with all the benefits you get for the subscription price, so those are all positive signs. When you look at the split between revenue growth and unit growth, you do see some impact of the lower ASP products that we're selling, as well as some of the trade down that consumers are doing. But we take that as a real positive. Seeing the growth in everyday essential categories, which are really predicated on speed. So you have to have fast delivery to be able to sell those products to customers. And when you do, it results in a stickier consumer relationship, higher orders, building larger baskets, which help our ship economics, and repeat orders are stronger. So those are all positive signs, and we will take any short-term degradation in ASP because what we're focused on primarily is free cash flow here, and we see the ability to unlock whole new elements of the consumer spend.
I'll just add, Eric, on the lower ASP strategy. There's an expression that we've used a lot of times over the years that it's easy to lower prices, but it's much harder to be able to afford to lower prices. And the same thing is probably true about lower ASP items. It's pretty easy to choose to supply them, but it's much harder to be able to afford to economically supply them. And so one of the reasons that we have been so maniacal about cost to serve over the last few years is that as we're able to take our cost to serve down, it just opens up the aperture for more items, particularly lower ASP items, that we're able to supply in an economic way. And when you layer on top of that, that broader selection, you layer on top of that faster speed and what we're able to do in getting items and fulfillment nodes local and close to our end customers, what we're able to do in expanding our same-day network, which allows us to ship same day, but also is one of our lowest cost ways to ship, is it just lets us serve so many more of customers' shopping missions. And that's what we're seeing in our business right now. But again, I think there's a lot of opportunity to continue to expand that.
And the next question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Great. Thanks, guys. Good afternoon. Question on online stores. The third-party unit mix declined a little bit in Q3, which is unusual. So just wondering if there are any specific drivers of that shift. And then secondly, you made a lot of progress with the AI agents on AWS and for sellers and Rufus for buyers. I wonder, with all the underlying data that you have and leveraging those agent capabilities, if you could provide any perspective on what a next generation Alexa might look like, and your opportunities there to perhaps drive incremental revenues. Thank you.
Sure, Colin. Thanks for your question. On the first one, third-party sellers. Yes, the percent of paid units was 60% in Q3, and if you look over the last 2 years, it's essentially was at 59%, stepping up to 60%, stepping up to 61%, pretty much every second quarter. So what we're seeing is it's still in a tight band between 59 and 61, but what we're seeing is the impact of the everyday essentials. There's probably the 3P demand is still strong, and unit volumes are strong. It's just the everyday essentials tend to skew more to 1P than 3P.
And on your second question, Colin, around Alexa, I think we have a really broad number of Alexa devices all over people's homes and offices and automobiles and hospitality suites. We have about 500 million devices out there with a couple 100 million active endpoints. And when we first were pursuing Alexa, we had this vision of it being the world's best personal assistant, and people thought that was kind of a crazy idea. And I think if you look at what's happened in generative AI over the last couple of years, I think you're kind of missing the boat if you don't believe that's going to happen. It absolutely is going to happen. And so we have a really broad footprint where we believe if we re-architect the brains of Alexa with next generation foundational models, which we're in the process of doing, we have an opportunity to be the leader in that space. And I think if you look at a lot of the applications today that use generative AI, there's a large number of them that are having success in cost avoidance and productivity. And then you're increasingly seeing more applications have success in really impacting the customer experience and being really good at taking large corpuses of data and being able to summarize and aggregate and answer questions. But not that many yet that are really good on top of that in taking actions for customers. And I think that the next generation of these assistants and the generative AI applications will be better at not just answering questions and summarizing, indexing, and aggregating data, but also taking actions. And you can imagine us being pretty good at that with Alexa.
And our final question comes from the line of Justin Post with Bank of America. Please proceed with your question.
Great, thank you. Maybe a couple questions. Just on the cloud, are you at all capacity constrained, and will the new Trainium or NVIDIA chips, maybe even drive sales growth faster? And then secondly, Andy, I know there's been some competition from some of the more traditional retailers growing quickly online. Maybe talk about maybe the advantages that Amazon has with the fulfillment center distribution versus store distribution. Any thoughts on that? Thank you.
Well, on cloud, Justin, what I would tell you is that I believe we have more demand that we could fulfill if we had more capacity today. I think pretty much everyone today has less capacity than they have demand for, and it's really primarily chips that are the area where companies could use more supply. And so, we're growing at a very rapid rate and have grown a pretty big business here in the AI space. And it's early days, but I actually believe that the rate of growth there has a chance to improve over time as we have bigger and bigger capacity. And I think that one of the reasons I mentioned in my opening comments that we have a very deep partnership with NVIDIA. We tend to be their lead partner on most of their new chips. We were the first to offer H200s in EC2 instances, and I expect us to have a partnership for a very long time that matters. It's also true that for customers that start to scale out their implementations on the inference side particularly, they realize pretty quickly that it can get costly, and it's really why we have pursued building Trainium and Inferentia, which is our custom silicon. And the second version of Trainium, Trainium 2, will start to ramp up in the next few weeks, and I think it's going to be very compelling for customers on a price-performance basis. And we have a lot of customer interest. We have gone back to our manufacturing partners a couple times now to produce a lot more Trainium than we anticipated. Some of that, for sure, is due to the fact that we have very large demand, and we want more capacity and supply to be able to provide them. But a lot of it is that customers are excited about the price performance that they believe they're going to get in Trainium. So, I think it's a very significant opportunity for us in the AWS space, and it's going to be a very significant opportunity for customers. I think on the retail side, I'd start by just saying that we've always believed that competition is very positive and very healthy. It's good for consumers. It's good for businesses. It's actually great for innovation. And if you look at the retail space, it's a very, very large market segment. I mean, we have a pretty big retail business, and yet we're only about 1% of the market segment share of the worldwide global retail market segment. And still about 80 to 85% of that market segment share lives in physical stores. And so if you believe that equation is going to flip in the next 10 to 20 years, which we do, there's just a lot of opportunity, not just for us, but for several players. There won't be only one successful player. I do think that we have some elements of our customer experience that are really unusual and unlike others. I think we have meaningfully broader selection than almost all the players that you probably have seen and heard of. We have low prices with very significant deals that we go work with our third-party selling partners around, key holiday shopping occasions. And then we have that the faster that we're able to promise customers that we can get them their items, the more frequently they buy and the more they actually use Amazon for their shopping needs. And so those are things that are pretty different. I also think we have a way of prioritizing customers that I think is unusual. Our orientation, our DNA at our core at Amazon starts with the customer, and everything moves backwards from that. Any meeting you go to inside of Amazon, we're always asking ourselves, what do customers want? What do customers say? What do they not like about the experience? What could be better? And that customer orientation is very important, not just in how you take care of customers, but the world changes quickly all the time, and the technology is changing really quickly. And so if you have the combination of strong technical aptitude, propensity, and a passion for inventing, and then also a customer orientation where it drives everything you do, I think you have an opportunity to continue to build great trust in a business over a long period of time.
Thanks for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to talking with you again next quarter.
Any change in behavior from a consumer perspective in terms of which sort of on the mix front within the iPhone series where consumer adoption is, given that there's more consistency of the features when it comes to Apple Intelligence across the board? And I have a follow-up. Thank you.
It's tough to answer your question because we've been constrained in October on the Pro and the Pro Max. And so it's really too early in the curve to call the precise mix on the consumer versus the Pro. So we'll see.
Yep. And for my follow-up, Tim, during the quarter, I think over the last 90 days, we had the quotes come out in relation to the DOJ relative to the Google sort of revenue sharing agreement that you have with them. How do you sort of look at it going forward in terms of emphasizing the role that Apple has in that ecosystem with Safari and sort of the potential outcomes that you're looking at? Thank you.
You know, I don't want to speculate on that from a legal point of view. It's an ongoing case, and I will save that for another day.
Okay. No, thank you. I'll leave it there. Thank you.
Yeah.
All right. Thank you, Samik. Operator, may we have the next question, please?
Our next question comes from Richard Kramer with Arete Research. Please go ahead.
Thanks very much. For my first one, Tim, I'd like to ask about some of the components and services where, despite your installed base, some parts of the Apple One bundle, like music and news and arcade and fitness, are not obviously the market-leading offerings. And maybe what might change that, and what other services could you call out as growing faster, having wider or widening addressable markets like we've seen in pay or advertising?
The way that I view it is that we have lots of opportunity in all of those. And so there's lots of customers to try to convince to take advantage of it, and we're going to continue investing in the services and adding new features, and whether it's News Plus or music or arcade, that's what we're going to do. Keep in mind that for us, we're more focused on being best than being most. And so in some cases, not in every case, some of the services the majority of the services that you mentioned are not cross-platform. We make them for our customers only. And so that in some cases changes the person who's going to sell the most, perhaps. But that's our objective, is to make the best.
Okay, thanks. And then, Luca, one piece of unfinished business was your pledge to get to a net neutral cash position. And over the last 2 years, you stayed around $50 billion of net cash. We've clearly seen instances in the past where elevated marketing spend or other programs brought increases in market share. I guess my question, looking back on your tenure, is at your scale now of $57 billion of OPEX, do you still see incremental ways to put that cash to work in the business, or will we just continue to see increased shareholder returns?
Well, obviously, as you've seen, our OPEX has gone up over the years. We've also seen at the same time a significant expansion in gross margin, maybe to a level that I would have not expected a few years ago. But we've done a very good job on a number of fronts. And so I would say every time we plan for the upcoming year, we think about all the different areas where we can deploy our resources, and we make them available to grow the business. I think we've done very well over the long term, but our fundamental philosophy is to look after the business first, and then if we have excess cash, we will continue to return it to our shareholders, and the plan has worked quite well so far.
Okay, thank you very much.
Thank you, Richard. We'll take our last question, please, operator.
Our last question comes from Atif Malik with Citi. Please go ahead.
Thank you for squeezing me in. It seems to us that the spec differentiation between iPhone 16 Pro and base models isn't as big as prior years. All iPhones have new A18, A18 Pro chips, and there wasn't an increase in ASPs versus last year. Can you share with us if there is a shift in your strategy in terms of...
Unfortunately, Mr. Malik's line has dropped.
All right. Sorry, Atif. We'll connect offline. Thank you, everybody. A replay of today's call will be available for 2 weeks on Apple Podcasts as a webcast on apple.com/investor and via telephone. The number for the telephone replay is 866-583-1035. Please enter confirmation code 0331536 followed by the pound sign. These replays will be available by approximately...
Okay, everyone. So overall, I mean, we really only caught the last 10-15 minutes of Apple's earnings call, but for the most part, Amazon, I think, was pretty solid. More focus on AWS and artificial intelligence as expected. As Andy Jassy, that was one of the reasons why he took over, because there was going to be more focus on AWS, the cloud services and artificial intelligence business. Didn't get a lot of insight into the e-commerce platform or retail, but all in all, I think it was a pretty solid report from the company. Increasing guidance was pretty strong. Apple did drop. I'm going to have to go back and check exactly what happened around 5:20 p.m. Eastern, 20 minutes after the call started, because there was almost a 2% drop here in Apple, and it is still down almost 2% after hours, with Amazon, of course, leading the charge up over 5% at the moment. Volatility is still pretty elevated, up over 13, almost 14% higher, trading at over 23 as the Money Invest Index closed at 3.3 as well. So thank you so much for joining, everyone, for this really long live stream of Amazon earnings, as well as a little bit of Apple. Make sure that you drop a like and hope you enjoyed it. Subscribe to the channel. The market updates coming out shortly. And as always, happy investing. And make sure that you do check out the links down below if you're interested in joining us. 16% annual discount expires midnight tonight. So today is pretty much the last day that annual 16% discount expires. You get access to the entire website, all the trade alerts, options alerts, everything's going to be included.